Good evening, ladies and gentlemen. A very warm welcome to FSM1.com's flagship event, What and Where to Invest 2021. This year, FSM1.com intends to help you put together your investment survival kit to ensure that you survive and thrive in your investing in 2021 and beyond. We have a lineup of online presentations today, as well as on the 19th, 21st and 26th of January in the evenings from 7 p.m. to 9 p.m. Over this series of presentations, we'll cover various topics to put together for you a suite of survival kit items and the respective tools that will be helpful to you as an investor as you navigate new market conditions in the coming year. Today is also the start of the opportunity for you to earn chances towards your lucky draw. Be sure to join us each event day till the 21st of January to earn chances to help you win in the lucky draw. Accumulate chances throughout the event for the draw happening on the 21st of January, where the winner stands to win up to $1,000 worth of FSM1 Auto Sweep account credits. There will also be 10 consolation prizes of $100 FSM1 multi-currency cash account credits each up for grabs. To be eligible, head to Event Live via the link in the confirmation email you received when you registered for the event. Remember to use the same name or nickname and email address in order to accumulate the chances. Here is how you can earn those chances. You can log on each event day until the 21st of January 2021. You can also earn your chance by participating in the daily quiz sessions. You can also earn your chance by completing and submitting the survey on the 21st of January 2021. Or you can visit our partners' pages. They are Nikko AM, Schroders, UOB AM, and Allianz Global Investors. Lastly, you can also earn your chance by sharing this event on your social media through the social media buttons on the footer. Remember to access Event Live using the same name or nickname and email address each day so that you can accumulate as many chances as possible. Each day, you can also take part in the daily quiz, where we will be giving away $100 worth of FSM1 multi-currency cash account credits to 3 lucky winners during the sessions until the 21st of January. The theme for today's presentation is Strategy Playbook for 2021. And this 3D map here represents how we often aim for a well-balanced and diversified portfolio. And in order to do so, we need to learn how to cut through the noise and into the realities of market to seize opportunities. Navigating the investment universe can be overwhelming, much so if you are facing an unexpected situation. At FSM1.com, you can always choose to seek a helping hand from professionals who have mapped out the treacherous terrain for you. As we gear up for the start of the sessions today, you'll note that we have opened up a poll. So do interact with us and the various people watching in sharing your experience and opinions in the polls. So to participate in the poll, you have to first click on Event Activities in the menu below this video. Under the agenda, look for the poll schedule, then click on the Join Poll button. The poll window will be displayed on your right. Let's start with the poll. Question 1. In 2021, will you be investing for growth, income, or both? Option 1, go for growth. Option 2, invest for income. And option 3, it is dependent on opportunities. So 45% of us are going for growth, with 14% investing for income, and the rest dependent on opportunities. Question 2. What will be your key investing strategy for 2021? Will you be active, passive, or both? Cast your votes and share your experience with us. We'd like to know. And 56% of us are going to be both active and passive, with 33% of us active and 10% of us wanting to be passive. Our last poll question, in 2021, what will be your investment style? Are you going to be aggressive, moderately aggressive, balanced, moderately conservative, or conservative? Most of us have decided to be moderately aggressive. Thank you for sharing your experiences. With that, let's kick off today's session. 2020 was a winning year for investors who invested in companies like Tesla, Zoom, and Sea. But will growth stocks continue to reap supercharged returns in the coming year? In this session, we explore whether you can still invest in growth for 2021, or if markets are already overvalued and it is time for you to put your money in high-quality dividend stocks and invest for yield. Please help me welcome to the stage Rusmin Ang from The Fifth Person to present Go for Growth or Dive In on Dividends in 2021.
All right, thank you, Geraldine, for introducing me, and FSM1 for inviting me to this event. So when they invited me to this event, they actually gave me a very interesting topic to talk about this year, because I find it quite relevant as we enter the year 2021. All right, so is this the year where you should focus your strategy on income investing, or is it the year that you should be doing growth investing, right? So I saw the poll that you guys just did, and I think almost half of you actually prefer to go for growth, whereas the other half will actually say that you are pretty much dependent on the opportunities, right? And then there are about 10% or 15% thereabout that want to focus on income investing strategy. It's kind of an interesting poll because the year of 2020, I think a lot of income investors must have suffered a big time. That's why I think 2021, it probably be the year where it makes more sense to go for growth. Okay, so let me first touch on the basic, just in case some of you are very new, because 2020 is a year where we saw a lot of new investors actually joining FSM1 and a lot of brokers out there. And yeah, so if you are new to investing, first let me explain the basic first. So if you are someone who is a growth investor, you do growth investing strategy, this is a strategy where you look for companies that are growing really fast, and these are the companies that in the industry that are actually growing rapidly. Sectors like cloud computing, and then you have AI, artificial intelligence, e-commerce. These are the sectors actually growing very fast. And this company generally, they don't make money. Most of them are actually loss making. The fact that they actually invested a lot of their profit back into the business, and that's the reason why they are considered growth companies, right? So generally, if you invest in this sector, you are looking more for capital gain. And these are the stocks that when you put your money, $10,000, you expect them to double or triple up in the next 3 to 5 years. Okay, so these are kind of growth investors are expecting this kind of result they want to have this kind of result. On the other hand, if you look at income investing, these are the investors where they look for companies that are relatively mature, they are a lot more stable, and they invest in those companies that are already giving out a lot of dividends to the shareholders, and the kind of yield they're expecting generally in between 3% to as high as 7%. And in today's market, you can find those companies easily, right? So you are mostly investing for dividends. Okay, so which strategy is better for you in the year of 2021? Okay, so well, I have the answer, but I have 20 minutes to speak here, so I'm just probably going to give you the answer towards the end. And yeah, if you look at the portfolio that capture the growth investor as a growth investing strategy, if you look at the portfolio as a whole, this is the fund where it belongs to Kathleen Woods. I think she was here. she was here actually to talk about growth investing, right? And on Saturday, I think, some of you actually tune in, and this is a portfolio I think they have done very well in the year of 2020. I think the fund have actually almost doubled up in the year of 2020. And you look at the companies, or rather the performance, since inception, you are looking at the annualized growth rate around 30% on a year-to-year basis. This is very impressive if you compare the result that Warren Buffett achieved over his investing career, about 60 to 70 years. You're looking at about 20%, which is very, very impressive. And Cathie Woods beat Warren Buffett in the year, since inception for her fund, right? And if you look at the company that she invested, a lot of them are actually growth companies. You look at the first one is Tesla. Right, Tesla has done remarkably well in the year of 2020. Will they continue to perform in 2021? We will look into that later on. And of course, some of the companies, Datadog, Roku, Square, and a few other companies. So if you look at the list of companies that are owned by Cathie Woods, these are the companies that I will consider them as growth stock because most of them are loss-making, but what they have in common is that their revenue actually growing very fast on the year-to-year basis, right? So on the other hand, if you look at a portfolio or ETF that capture a group of income stocks, and I think the closest one that you can look at closer to home is Straits Times Index. Okay, so you look at the Straits Times Index, basically it made up of 30 blue chips company in Singapore, the largest one, and then they kind of trace the return over the years, right? So if you look at the performance for STI, I think they have delivered an annualized growth rate around 6%, which is very impressive. Of course, if you compare it to growth investing, Cathie Woods, the ARK Innovation ETF, they have significantly downperformed, right? So it seems like 2021 is going to be, it makes more sense for you to focus on growth investing because Cathie Woods has done very, very well, right? And yeah, so just to give you an idea, what are the stocks on the STI ETF, right? If you look at the top three banks, DBS, OCBC, UOB, and you look at Singtel, Jardine Matheson, and then the list goes on. Basically, these are all blue chip companies that pay very stable dividends. The yield is ranging between 3% to 7%, right? So let me summarize what happened in 2020, just in case those of you who just joined us this year. 2020 is a year where if you're a growth investor investing in companies like Tesla, you'll probably make a lot of money because Tesla has almost, 7 times the return in the year of 2020 alone. And of course, if you do crypto investing, those of you who invest in Bitcoin, you have also done very well. And the year of 2020 is not so kind to people who invest into income. And that's the reason why I saw the poll that you guys did was only like 11% are interested to invest into income because you guys have suffered huge capital losses. Because if you look at STI, year to date, in fact, since 2020, before the pandemic happened, they are still down. They have not really recovered that much, okay? And for those of you who do value investing, sadly, I saw a lot of my friends who do value investing, they have given up all the strategy together and they dump that and they jump into growth investing because it seems like this is the way to go. A lot of people make so much money, right? And the reason why they switch is very simple. The grass is always greener on the other side, right? So it makes sense for you to join the camp. You can't beat them, join them. Okay, so these are some of the companies that have done really well and probably convinced a lot of value investors to switch dump their strategy and switch into this type of company. Top one, the popular one is going to be Tesla. And then I'm just going to pick up some of the popular names that you guys are very familiar. Zoom, the last two on the list. And then the last one is Sea, which is closer to home. This is a Singapore-based company. They have a gaming business. Some of you do gaming. You're very familiar with G Arena. And the other business they own is actually e-commerce Shopee's app. Okay, so they have actually done also very well. Okay, so let me go back to 1990s, right? The day when Microsoft was very popular at that point of time. This was the coolest kid in town. Today is Tesla, okay? So let's go back to the history, right? You look at the revenue for Microsoft from 1990 all the way to 1999, you will see a very impressive result because Microsoft was at the front runner in the PC sector where they were, at the time PC was selling like hotcakes. So Windows being the operating system of all the PCs, they were actually making a lot of money. Their margin, you are looking at about 30 to 40%. And they were growing at 36% on the year-to-year basis. And if you look at the net profit, they are growing at about 45% on the year-to-year basis, right? So at that time, if you look at the share price of Microsoft, it has done really well, right? Whichever year that you invest in 1995, 1996, 1997, you will make a lot of money from Microsoft, right? At the time, if you do your valuation, Interestingly, this is the kind of valuation that Microsoft was trading at that point of time. They didn't pay any dividends, that's why the yield is 0. And they're trading at 31 times price to sale, PE of about 79 times. And fast forward to today, if you assume that you bought Microsoft at $50 to $60, right? And fast forward to today, 20 years down the road, this is your performance, right? Your performance for Microsoft had quadrupled, right, in terms of return, and over the years, you have compounded your return at about 7%. Why is it so low? Because it's 20 over years. You are looking at the compounding number of years there, right? But I can't imagine how many of you actually hold on to Microsoft for a solid 15 years when they were down because of the tech bubble, right? So at that time, there were a lot of investors was hyped up because of the media and everyone was rushing into the internet companies like Microsoft, right? And the other one that is very cool in town is Intel. So Intel, briefly, right, if you look at the share price of Intel, you can see that they actually run up in the 1999 to 2000, and the bubble burst. Eventually, until today, Intel has not really recovered from the tech in the early 2000s, right? And yeah, so pretty much down. Intel didn't make it to today, but they was the coolest kid in town. The same for AOL, right? So this is the company that bring Americans online, a lot of Americans online actually. So AOL was thought to be the so-called everything of internet, right? And who knows, today they're no longer around, right? They have instant messaging, mail, search, everything, right? They also have subscription business at a point of time. So this is a company that was trading at about 33 times price to sales, right? Not price to earning. You can't value a loss-making company based on PE ratio, as what Kathy would say. And today, let's fast forward 20 years down the road. If you look at Tesla, right? Tesla is the coolest kid in town because everyone wants to own Tesla car and stock, okay? And if you look at the revenue for Tesla, they actually have been growing at about 50% on a year-to-year basis. In terms of net profit, of course, I can't quantify it because they are making losses. And if you look at the share price of Tesla, they have 7 times the return in 2020, and 2021 seems to be the year where it will continue to explode in terms of share price. Let's look at the valuation, right? The price of sales of Tesla is about 29 times, which is very similar to Microsoft back in the tech bubble era, right, in the 1990s. I'm not saying Tesla is going to crash, okay? I'm just pointing to you that a lot of expectations are being put on Tesla, right? So they are priced for perfection. Investors expect Tesla to continue to grow. If they don't grow, they're going to punish the share price, as what they did to Intel and AOL, eventually collapsed, right? So yeah, where it goes in 2021 is, your guess is as good as mine, actually. I don't have the answer for that. But it's very expensive. If you're a growth investor looking to invest in Tesla, just be careful with it, right? And other companies is C. So this is a Singapore-based company. And if you look at the share price of C, they have quadrupled in terms of return in 2020. And they say it's going to be this company is going to be an Amazon of Southeast Asia because this is the market that they are in. And I'm a Shopee user myself, right? So you look at the C valuation, the price to sales is about 30 times. And you look at the earnings, I mean, this company is still loss-making. Okay, their gaming business is making money, but e-commerce platform is loss-making, but they're using gaming to fund the e-commerce business, right? So at this valuation, I think they are priced for perfection as just like Tesla, right? But if you think Tesla or C is crazy, let's look at this company called Zoom. All right, so Zoom is an app that all of us use, right, in 2020 until today. In fact, you guys are watching this through Zoom, some of you. And you look at the Zoom share price, they have done remarkably well. And at one time, at the peak in October, right, 2020, they are trading at a price to sales of around 124 times, right? So it's way crazier as compared to Tesla and C. And they are not making money, right? So it doesn't valid to them. So where is Zoom going this year down the road? I think the prices are actually coming down. The price to sales as of today, as I talk to you, will probably be fluctuating at around 60 to 70 times. It's still very high. I don't know where they're going, but there are too much expectation in Zoom, right? So the management have to really deliver that kind of solid growth of 80%, 100% on a year-to-year basis, which I think is not going to be possible because 2020 is an exceptional year. We have COVID-19. There's an acceleration in terms of adoption of technology and many other things, right? So yeah, I just want to share with you this particular book called Bull, right? So this is a very old book written by Maggie. And she did a fantastic job of looking at the past market cycles since 1982 all the way to 2004. She went on to interview some of those people who participated in the bull and bear market before it collapsed and after it collapsed. And she went on to interview them and what was going on at that point of time, right? And she come into conclusion that in every bull and bear market, there was always this story about something is going to change the world, which is the disruption, and everybody is so into it, and people start to put their money in those stocks, and eventually it created the bubble. Not the stock itself, but the bubble, because everyone have so much hope on this company, and everyone is buying the same pool of stock. It actually created the bubble itself, and this is where it planted the seeds for the bubble to burst, right? And I don't have time to go through with you the book, but it's a very good book. And in fact, if this book continues to be written, I think 2020 is going to be a year where it's probably a bubble where I'm seeing some of the companies are trading at a crazy valuation. And some companies that are affected by COVID-19, they are trading at a way higher above the pre-COVID level, which is crazy, right? I thought I would never see that in my life again, right? But it's happening right in front of our eyes. This is not to say that you should not invest in tech companies. In fact, I do invest in tech companies myself. And when opportunities come up, in 2020 in the March, actually we invested a lot of our money in some of these tech giants that are listed in US. Adobe is one of them, and Amazon is also another one. And there are many more which we bought it at a very good price. Okay, so this company, Amazon, for example, they are just trading at around, they were trading at around price to sales of less than 3 times when we bought them. Okay, so they are not that expensive, quite reasonable, but I'm not telling you that you should go and buy companies that have a price to sales of less than 3 times. No, right? You need to look at the company business, the industry that they are in. For Amazon, they are in the e-commerce, which is riding on the trend, and they're also into the cloud computing, which is going to be the future, right? So Amazon, at least to me, at that point of time, was trading at a reasonable valuation, right? Today, Amazon is still not that expensive as compared to Sea or Zoom. All right, so I think I'm not taking too much risk when I invest in companies like that. Okay, so this is also not to say that I'm going to dump all my tech stock because I'm seeing a huge bubble forming. All right, I'm not here to try to time the market, but I'm here to tell you that there are too much expectation in the market. Right, so valuation to me is something that is very, very important. It's something that I hold closer to my heart. I know in the era of 2020, 2021, people have started to throw the valuation out of the equation because they think that valuation is not important as long as the companies continue to grow. All right, because look at Tesla, look at all those companies, Zoom, that have run up so much. Their valuations are crazy. It simply means that they are no longer important. But let me warn you, if you start to throw your valuation out of the equation of your investing, this is where you start to plant the seeds of the disaster for your own portfolio, right? Because I don't know, I think growth companies, a lot of them are being priced for perfection. So 2021, some of you, in fact, half of you actually wanted to go for growth investing. I will say that it will be a better strategy to look for companies that are much more distressed now, neglected. And these are the area where income investing strategy will come in very handy, right? So let's look at why I say that. Okay, so if you look at the general market valuation, this is the ratio, PE ratio, where it gives us a quick rule of thumb whether the market is expensive or cheap. So if you look at the S&P 500, the PE ratio is actually trading at a historical high, right? If you look at the past 10 years, they are way above the average, which is the orange color, the line, right? And yeah, so it's way above it. And if you look at another market like Singapore, Singapore is trading at an average price to book ratio below that, significantly below. It has been recovering over the last few months, but until today, as I speak to you, they are still trading below the average. And yeah, so what are the companies that in Singapore that I find it quite attractive? Over the last few months, only recently have run up. I think until today, they are still considerably quite attractive. Sectors like bank. I think on Tuesday, you probably have heard some speaker highlighting to you some of the banks opportunity that you can look at, some of the ETF that you can actually look at. And I do agree with them that I think bank is a sector that was actually heavily sold down during the COVID-19 because banks actually cut dividends. But again, this is just a temporary issue, and I'm not seeing that happening over the long run. And if you look at banks, MAS also say that banks in Singapore are relatively resilient. Right? So if anything goes wrong, you know who to look for, not me. Okay, MAS. And another sector that you can actually look at is going to be REITs, right? Real estate investment trust. So REITs in Singapore is a very popular just like bank for income investor, right? These are the kind of stock where it gives you a yield of about 5%, 4%, 6% easily, right? I mean, they come with a very stable yield. They don't just pay you one-time yield and then they collapse the next day, right? It doesn't happen that way. But REITs is a very broad sector also. I don't want to go too much into that sector, but just to summarize it, the sector that you can look at is retail, which has been beaten down because of the pandemic. People thought that all of us would stop going to the shopping mall, right? So all the retail stock was beaten down at the point of time, and recently they've been recovering pretty well. And then the next sector that you can look at is office, right? Because of the work from home trends. So people started to believe that office is no longer relevant today. They're going to dump office stocks, and then eventually office REITs suffer. Right? Of course, today people start to realize that the importance of office. You still need to go to office, except that you probably might do more flexi working. Some days you work from home. There are some days you work from the office itself. Okay, so and Singapore is a very sweet spot when it comes to office market. You look at some of the office markets over here. I think Singapore is a very good spot for international companies to come to reach out to Southeast Asian market, right? So you probably saw a lot of news on that. And the other market that you can look at for income investing is going to be Hong Kong. So Hong Kong, I think generally are still trading at a very attractive valuation. Again, the same sector that you can look at are bank, REITs, property counters. Those are the sectors that are trading at a very attractive valuation, right? So just to summarize what I just want to share with you. So 2020, is it a year where you should go for growth or income? Okay, my answer to you is it depends on opportunity. So I agree with 50% of you here that actually voted, you should go for 50% of your portfolio into depend on opportunities, right? And then, but based on today's market valuation, if nothing changes, I think income investing works better, in my opinion, because growth investing, there was simply too much expectation that are built into those companies, right? So you can use rule of thumb. If you're 100 minus off your age, you can actually size the portfolio of the allocation into growth companies, right? So let's say if you are 30, maybe you can size 70% of portfolio into growth. If you are 50s, of course you want 50-50. Again, the answer depends on you. No one can give you a perfect portfolio allocation, right? So that's all I have for you. Thanks for watching, and I'll pass it back to Geraldine, right? Thanks. Yeah.
Thank you, Razmin. Megatrends are structural forces that are slowly changing the way we live and work. Often, we don't realize these shifts happening because we are part of this gradual shift. Come on in and hear from Sean Tiao in this session to understand what these megatrends are and how you as an investor can capitalize on these long-term growth opportunities. Presenting Active Strategies to Capture Key Megatrends is Sean Tiao, Senior Analyst, Unit Trust Research, IFAS Singapore.
Everyone, thank you for tuning in. Good evening, everyone. Thank you for tuning in to tonight's presentation. So I represent the Unit Trust Research team at IFAS Singapore. So today, my topic really is to talk to you about some of the mega trends that's actually ongoing right now around us. And I'll be sharing with you as to how you can actually find opportunities with Unit Trust with having this mega trends framework in mind. So before we begin, I would just like to talk to you about what are mega trends. So essentially, mega trends are trends that are basically immovable, structural in nature, and that's something that is pretty much irreversible. And I think what gives rise to mega trends is basically, sometimes there could be major changes to attitudes or beliefs that actually change the way we live and work. So I would say one mega trend that has actually that we've actually gone through recently is that is actually brought about by COVID-19 is the increasing digitization of the global economy, which I'll be touching on later. But the thing is, when you think about mega trends, it's actually quite difficult to capture like one trend with just one investment product or with one ETF or one stock. And which is why I think active strategies could actually step in with this perspective because they tend to be more broad-based. And I think when you want to think about mega trend, we have gone through quite a number of mega trends so far. I think one of the key mega trends that continue to affect us today is demographics. Some others include, our transition from being one that is an industrial-based economy to now we are an information-based economy, and the fact that we used to be more domestic-oriented, and now we are pretty much globalized across the world. So I think just to run you through what are the key mega trends that I believe are shaping the world that you can access through unit trust are basically these 4 mega trends. The first one would be green revolution, right? We have seen an increase in people wanting to do good for the environment, and not just that. Demographics continue to shape our world, right? You know, World War II to the baby boomers, to the millennials, to the Gen Z, Gen Y, the demographics continue to change the way we know how businesses and societies live. The third thing is basically digitalization. Like I mentioned earlier, I think COVID-19 has accelerated this process, which I believe has numerous investment implications for investors. And last but not least, I think there's been an increase in disruptive innovation in today's environment. And again, I believe this is also enabled by technology. So without further ado, let me just quickly run you through like what is giving birth to this green revolution. So the thing about why green revolution today is such a big thing is because basically, I think there's been increasing consensus that we cannot continue to live like how we are living for the past 5 to 6 decades, right? We have been using a lot of resources, and I think the key thing about green revolution is basically that we need to cap our carbon output because the world is simply the world's global temperature is simply rising too quickly, right? So this gives rise to a lot of opportunities to companies that deal with sustainable solutions, or actually companies that actually conduct their business in a very sustainable manner. And if you look at this survey over here that's done by Morgan Stanley, you'll notice that there has been an increasing appreciation for climate change risk. People are starting to realize that, oh, this is a risk, and that they're more willing to actually do something about it. And of course, this change in sentiment is actually increasingly being present in the growth in sustainable strategies over the last few years. And as you can see, sustainable strategies now is worth about $30 trillion US. And one way to think about it is that people who invest in this strategy, they want to do good for the world. And increasingly, this group of people will have increasing sway on how capital is allocated. So all these have implications on companies as well as from a capital appreciation perspective, because it's more likely that companies that consider ESG into part of their business models, they are likely to see better returns versus those that do not. So how can we gain exposure to this green revolution mega trend, right? I would group them into 3 teams, right? One is basically green energy, and I think this is something that's represented by 4 funds that we have over here, and one of which is actually our best performing fund, BNP Paribas Energy Transition. And another way to think about investing into this mega trend is actually ESG, investing in companies that actually do good for the environment, right? And you can actually access these through global equity funds, because these funds actually do an ESG screening as part of the investment process to make sure that they're allocating capital to companies that are actually sustainable in their practices. Another way to think about investing in this green revolution is not just investing in hyper growth companies that can solve our energy problems, but also companies that actually recycle and ensure that we deal with this resource scarcity problem, right? We also, and that includes funds like investing in water, or for example, funds that actually think about how waste is actually recycled and stuff like that. And if you look at the performance of the funds, you will notice that it's definitely jaw-dropping, right? And if you look at the top half of the table, which basically shares with you can see that the best performing fund on a 1-year basis is basically up 200%. And this is, of course, with these sort of higher returns, you can expect perhaps higher volatility, especially on the downside as well. If you look on the right side of the table, which basically highlights what the downside volatility for these funds are for their respective periods. But I think if you look at, for example, let's say you don't have much of a risk appetite. You look at the global equity funds. They do have they have shown to actually do well. Over the last 3 to 5 years, that was the period where they started to include all these ESG considerations into their investment process. You can see that you can make money by doing good as well. So next up, I'll talk about about demographics, the next mega trend. So, of course, I think in today's world we have very low population growth rate, but at the same time, I think our population is also living longer, and therefore, as a whole, we are growing older. And if you look at the chart over here, basically the percentage of population that it's expected to be 65 years and above is expected to rise over the next few decades. And of course, one of which the major contributors to that will be China. So this has a lot of investment implications for us to think about. Who is going to meet the demands of all these people who are growing older, who probably need more healthcare services, so on and so forth. And another thing that's affecting the demographics megatrend is actually urbanization. As people grow, as countries grow richer, more people from the rural places, they want to move to the urban cities for more opportunities, right? So this projection by United Nations is that by 2050, which is not too far away, about just 2 to 3 decades later, we'll be adding 1/3 of the current urban population to cities. So again, this presents a lot of challenges for urban cities as to how we can actually meet the needs of the future. And another point about it is that adds on to this urbanization thing is that we are not ready in terms of where we are, where our country is in terms of the infrastructure, right? Because if more people move on to the urban cities, we are likely to need more energy consumption. So this is an issue. Where are we going to get it from? And of course, like I mentioned earlier, more people moving into the cities, we are going to see a rising global middle class. And if you look at this projection by Brookings Institute, which is a US think tank, you'll notice that much of the global middle class will actually be contributed by Asia Pacific. And of course, no surprise, India and China will be the two main countries that will be adding to the middle class population. And over here's a table that basically shows you how China is expected to keep increasing its global middle class and supersede US in 2020. And in fact, China is already ahead of US when it comes to the population of their global middle class, or of their middle class. So how can we gain exposure to this demographics mega trend, right? So based on the themes that I've identified, I think there are 3 ways you can do so. One, if you want to look at aging population, I think the most straightforward way would be to look at healthcare funds. And with regards to the urbanization mega trend that we're talking about, that we're looking at, I think infrastructure funds could be a good idea because these funds actually invest in companies that actually are involved with, like, for example, transportation, toll booths, and so on and so forth. So I would say this fund actually is quite inflation sensitive, which you will see later on with regards to the performance of these funds. And thirdly, I think the next theme will be consumption upgrades. Like I mentioned earlier, I think China will be the biggest force in terms of how they're going to add to the global middle class. And I think one way to really just take advantage of that would be to invest in Chinese equity funds. So if you look at the performance of the fund over here, I think it's quite clear. But let me just talk about healthcare funds first. As you can see, the funds that I've identified, if we compare it to the benchmark, I think the results are quite clear. I think active strategies definitely have a place over here when it comes to investing in healthcare. The question is why? Because I think for a lot of these healthcare funds, they are not just skilled in financial analysis, right? they also hire, for example, people with PhDs or people with real scientific experiences to really think about whether or not a particular product, like a biotech product, will it be actually, is it viable? So I think this is something that perhaps passive strategies will not be able to give you insights to. And I think the performance of these funds, while they are more volatile for sure, I think they are able to provide this additional value for your investments. Another way, as you can see from the Chinese equity funds, like I mentioned earlier, it is a good way to play into this consumption upgrade that we are thinking about. And these funds have actually done really well, exceedingly well versus the MSCI China Index. And if you think about, like for example, the Allianz China A-shares, the A-share market is quite domestic oriented, and therefore, by virtue of that, you're basically buying into this consumption upgrade or premiumization upgrade that Chinese consumers have. And that's one reason why I think the fund has done pretty well. So the next trend I think we can look at is basically digitalization, right? It's something that I think all of us are going through right now. We are doing everything online-based learning, online-based work. We are using more, we are shopping more online, things like, and I think the trend is quite clear in this chart over here. But to be honest, even before COVID-19 actually happened, we have already been experiencing that. And I think COVID-19 has actually accelerated this growth. And we see like your sales for e-commerce online is expected to grow for 16% for the next few years. And this is quite remarkable considering that I think e-commerce is already 25% of all retail sales worldwide. Another thing about digitalization is the thing about fintech. I think with the recent announcement that like the new digital banks, I think this has come to the forefront of our news cycle. And if you think about what fintech is all about, it's not just payments. It's not just that we can open new bank accounts online. There's so much more to it, and it spans across various sub-industries, from lending to regulatory tech, to wealth management. And I think there are a lot of opportunities out there. So if you look at what the fintech, I would say the sector is all about, if you look at China, they have a really nice value chain where it's basically just controlled by a handful of companies, Tencent, Ping An, and Alibaba. So they have a full value chain of all these sub-industries. But if you look at the Western developed markets, it's more fragmented, and which is why I think there is an opportunity, there is a space for active strategies to come in, because it's not so clear-cut when you want to invest in fintech industries outside of China. Another thing about digitalization is, aside from that, is also 5G and the IoT, right? And I think Singapore is about to roll out 5G over the next few years, and I think we're going to have like 90% coverage by 2025 or somewhere along those lines. But the key thing about 5G is not that we can have faster download speeds for our movies or Netflix shows. It's really about what it can enable things to happen, right? I think factory automation is one big thing to look out for if 5G becomes fully rolled out, as well as remote surgeries and automated driving, of course. So IoT spending is expected to rise significantly over the next few years. But I think from a nearer-term perspective, despite like growth coming down, I think we can still see a healthy growth in spending for IoT products, especially when 5G comes online for most of us. And of course, driving this digitalization, I would say the bedrock is also artificial intelligence, right? Because it has a strong potential to actually disrupt industries across like a broad spectrum. How artificial intelligence can actually crunch numbers and impact on various industries. And generally speaking, I would say it's very useful in actually enabling innovation. Because without artificial intelligence, we don't have the data, we don't have the insights as to how various industries can actually improve on their own. And as we become more digitally connected, I think cybersecurity is also one area to look at, because with more people moving to cloud, moving to digital space, they want to protect their data, and I think this is something that will also benefit. So these are some of the unit trusts that you actually gain exposure to some of these themes that I've mentioned. And if you look at the performance of these funds, it's actually not too bad, right? And I think one key fund that I want to point out to you is actually the FinTech fund, right? If you think about financials, I think from a long-term perspective, they have been quite unattractive because of the fact that financials are basically cyclical plays, and that interest rates have been so low, they haven't been able to make so much money. But you look at the performance of this fund, you can see that actually they have done exceedingly well compared to the index. And that's because they have this secular growth driver where they allocate about 50% of their portfolio to fintech names and the other half to your traditional value companies, your traditional financial companies. And last but not least, let's move on to disruptive innovation. So this is a chart that I actually got from Lion Global, which I think is really useful in thinking about where we are in terms of this disruptive innovation S-curve, right? And basically what this chart is saying is that the old economy is ripe for disruption, right? We had disruption coming from retail, and that is something that I think Amazon and all that they have been working on over the last decade. But I think the future for disruption perhaps lies within the old economy, like financials and so on and so forth. And I think this is really enabled by the technological breakthroughs that we have undergone. So if you look at what are the potential industries that could be ripe for disruption, that includes perhaps your traditional factories, where perhaps we could have 3D printing in the future. So perhaps this will actually improve all these business efficiencies for a lot of sectors and drive productivity growth. So these are the funds that can gain exposure to the disruptive innovation trend. Of course, there are not a lot of products out there because it's still a relatively new idea compared to others. But I think, generally speaking, I would say that you need to have a high appetite when investing in disruptive innovation because of some of a lot of the companies are basically loss-making, and that they have pretty high valuations at this juncture. But of course, if you are someone who does not have that risk appetite, for example, by investing in the Nikko AM ARK, which has done really well, you might even consider funds like, for example, Lion Global or the ones that's offered by CPR Invest, because these, as you can see, they have lower downside volatility. And if you're someone who really worries about your portfolio on a daily basis, then perhaps you can opt for a less risky option. So why invest in unit trusts when thinking about mega trends? Why do you want to invest in unit trusts? So I think there are three key reasons. Number one, you are unsure of where to invest in. Number two, you want perhaps a deeper exposure to the full value chain of the entire mega trend that you're trying to express. And perhaps you don't just want to invest in Tesla, you want to invest in the battery makers, you want to invest in the companies that actually produce the commodity that enables batteries to be made, for example. And number three, you're worried that you're wrong, because essentially I think mega trends are predictions. And even if the predictions plays out, not every company in the space would prosper or perform in the same way, and therefore you want proper diversification. So I think when you think about mega trends, I would say the things that you want to take note is you want to keep your allocation when thinking about your overall portfolio to be small, because I think these funds or these trends have huge potential, but they also have huge risks involved. And you want to spread it across a handful of ideas and not just one, because ultimately things are not cheap for some of the segments that I've talked about. And I think to best improve your odds for success, you should actually have small regular contributions to these investments, so that you will not risk yourself worrying if markets drop by 20 or 30%, because these trends take decades to play out. So I hope I have given you a good idea of where you can invest in with mega trends, and I'll just pass my time on to Geraldine. Thank you very much.
Thank you, Sean. Just as a reminder, if you have any questions regarding the presentations today, leave them in the Q&A section by clicking on the Ask Question button and we'll have our speakers take these questions later on today. And now on to our next topic. The world is adapting to a new economic reality. Disruptors, in particular, have emerged as leading businesses that have leveraged on technology to overcome the challenges posed by the post-pandemic way of life. While the new reality of e-commerce, social media, and remote working is well entrenched in our lives, other disruptive trends continue to grow, including robotics, electric vehicles, augmented reality, and artificial intelligence. But disruptors are not immune to disruption, and the trend continues to evolve rapidly. Tech-enabled disruptors are no less immune to disruption than the traditional business strategies they once challenged. In such a fast-developing environment, the opportunity for investors who take a broader view on the megatrend of disruption remains. What strategy can access this broad and dynamic disruption megatrend? To help us answer this question, we have Lim Yu In, Fund Manager of the Disruptive Innovation Fund at Lion Global Investors, to present to us about a new decade of disruptive innovation.
Hello, hi, good evening. Thank you for dialing in. I'm Lim Yun, the Fund Manager of Lion Global Investors. Today, I would like to, within the very short 20 minutes, give an update on the developments at the disruptive innovation sector and also to give our outlook of this sector itself. But first, let me give a very short introduction of our company. Lion Global Investors is part of the OCBC Group with around 60 billion of asset under management. We are based here in Singapore, you probably have heard of us, and we have around 40 fund managers and analysts in the company itself. So quickly, everybody would know that disruptive innovation was the rage over the last few years. The Lion Global Disruptive Innovation Fund has also done well, especially for last year. The fund has gone up by 55%, and over the last 3 years, it has gone up by 19% CAGR, or annualized return over the last 3 years. So a lot of you will probably be asking, so what next? After such a strong rally last year, what do we expect for this sector itself? To answer this question, I hope to share our views on two issues. One, which is the macro environment that is happening from last year to this year, and also our outlook for this 2021. And the second thing is also to actually share with you the impact of COVID on the disruptive stocks. But first, let me highlight to you the 16 themes that Lion Global has identified as disruptive innovation themes or trends. As you can see over here, many of these trends are probably, you're probably quite familiar with, but still a lot of people will tell me that disruptive innovation equals to tech, but that's not true. The disruption actually takes place in all space of life. And you can actually see participants, for example, in the material space, for the batteries used in the electric vehicles, used in manufacturing, for example, factory automation and also robotics. So these are just some of the themes out there. So let's move on to the macro themes for last year, and some of these themes are actually relevant for this year. There are actually 3 themes last year that are very important. First, of course, is the development of COVID. That is a life-changing and a historic moment in the history of mankind, with actually implications for the future itself. Second is the US-China trade war. And lastly, the central bank and fiscal policies that were put in place last year because of COVID. For this, I would like to address each and every one of them. One, for COVID itself, the question is always, what about this new new strains that are coming up, and the rising infections, especially during this period where it is winter in a lot of the countries out there. Our view is that the mutations are actually minor and that the current batch of vaccines will actually be effective. So the issue of this COVID into this year will probably be when are we going to get herd immunity with enough vaccination. And our view, our base case is that we will probably have a reopening sometime in the later part of the year. The second important macro theme is actually the US-China trade war. And for this itself, it has got implications for a lot of the Chinese companies, the tech companies that are listed, and probably for some of the US companies also. For this, we are glad to say that with the Biden administration, there'll be probably less uncertainty because the Biden administration is more likely to follow international rules. As such, there'll be less uncertainty, which will be good for asset classes, for risk assets. And lastly, what about the central bank policies and fiscal policies? For this, we believe that with the still high unemployment rate and also a very low inflation, monetary policies would continue to be supportive to asset classes. For this, we refer to the very low interest rate, the historical low interest rate implemented by central banks across the world. And for fiscal policies, we believe that fiscal policies are still supportive in 2021. Some of the other macro trends that I've highlighted over here are probably less important this year. And with that, my key takeaway for this is that the macro side will probably be stable this year, although there could be some volatility, due to, let's say, the rising, let's say, infections for the COVID itself. But eventually, at the second half of the year, the economies will actually reopen. Oops. Second, I would like to share with you the impact of COVID on the disruptive innovation space. For this, I would like to highlight two observations. One is that these disruptive innovations are actually long-term trends, and COVID actually serves to accelerate some of these trends. These are trends that are pre-existing before COVID, and after COVID, these trends will continue to grow. So that's the first observation. The second observation is that for some of the disruptors that were slowed down because of COVID, for example, factory automation, because a lot of the workers cannot go back to work, as such, CAPEX has slowed down, factory automation has slowed down. But post-COVID, when workers return to the factories, CAPEX will continue to grow. The other areas could be last year, economic growth has slowed down, and as such, the sales of cars have actually slowed, which means that electric vehicles will also slow in terms of sales. But going forward, when the economy recovers again, economic growth recover, the demand for cars will increase. But at the same time, I would like to point out that innovation did not stop during this time. So for example, in electric vehicle, the price of battery actually continues to decline. And later I'll have a case study to talk about that. So the observation here is that innovation doesn't slow during COVID, and post-COVID, it puts them in a better situation. The first case study I'm going to talk about is digital transformation of work. A lot of us who have experienced this, work from home, right? And a lot of companies will be investing in technologies to actually help do that. I would like to quote, the CEO of Microsoft, who actually mentioned that he saw 2 years of innovation within 2 months. Our view is that this fast pace of innovation could slow, but it's unlikely to reverse. Over here, I would like to show you the technological curve for some of the technologies that will enable this digital transformation of our workplace. So over here, there's a lot of opportunities. There are some technologies that are in the expansion stage now, which we are invested in, like for example, cloud, video conferencing, data management. But there's also a whole bunch of new applications, new technologies that are in the infancy stage that will mature together with with this investment, this drive towards digitalization. So our view is that even from 2021 onwards, there will be these investments into these new technologies, and we will have new opportunities to invest in these companies. E-commerce. Everybody knows that, when the malls are closed, we have to buy online. So, it has changed consumer trends in terms of how we buy goods and also procure our services. So it is actually it is a no-brainer that the growth rate of e-commerce will be very high last year. The question then is, what next? Our forecast is that because of the high base, the growth rate will be slower this year. But there's no fear to that because it's still a positive growth. And next year, when the low base is over, it will revert back to its secular growth rate, which is still a very decent set of numbers. So e-commerce will continue to grow. Disruption is not only in the software space, but also in the hardware space. There's this long-term trend that is in place. I'll give one example, which is robotics and automation, which is a big trend, a big theme that our fund is invested in. This theme itself is driven by 3 areas. One, reshoring. Incidentally, COVID has also helped to drive this trend. When a lot of countries actually realize that they cannot rely on the efficient workings of the supply chain, it could actually stop during a pandemic. So there will be a lot of investments that are placed within their countries for key components, key products, and also medical supplies. So this reshoring trend will actually drive further growth of robotics and automation. The second trend that is in place pre-COVID is the aging population out there. Can you imagine that even China, which is the worst factory, is getting old? This is due to the single child or 2-child policies that they have years back. And for an aging society, they need to invest in robotics, in automation, to lower the labor content. And lastly, I would like to point out that with all these disruptions ongoing, it has a virtuous cycle. So for example, the growth of electric vehicles is expected to drive investments in robotics and automation. So what do I mean by this? Can you imagine the assembly lines for the internal combustion engine cars? They are very different from that of electric vehicle cars. So such trends, when it continue, would drive robotics and automation also. Our forecast is for the installed base of robotics to double over the next 5 years. So you can see how strong this growth are with or without COVID. And lastly, we would like to talk about the rise of electric vehicles. For this, I would like to highlight to you that this is not a COVID play, it's actually a recovery play. And just now that I have actually mentioned, when the economy was slow, car sales was down, electric car sales were also down. But with a recovery play, demand for electric cars will continue. And the other thing is that innovation hasn't stopped. The price of battery has actually declined. The advancement in materials is such that the price of battery is expected to drop to the extent whereby an electric vehicle will reach parity with an internal combustion engine car in 2022. Some say 2023 or 2024. But the idea is that it's going to be cheaper for you to buy an electric car. It will be more efficient, it's environmentally friendly. And this is added with the government push to reach carbon neutrality. And with that, there will be regulatory incentives for users to actually buy an electric vehicle. So the growth over here will actually be very strong. Just now, I've actually given a lot of case studies and trends to highlight that disruption will continue, and there's this wonderful growth that you can invest in. But one thing that I would like to remind our viewers is this, that with disruption, when you invest in disruption, it might come with its risk. This could be because a lot of these disruptors, they are actually coming up with new business model. So regulators may be slow to regulate them, right? Or or some of these companies could actually be risk takers, so they could actually go into trouble. So last year, I would like to give two examples. One, which is Wirecard. This is a major payment system company in Europe that's also used in Singapore. I think many of you would actually remember sometime in October of last year where credit card cannot be used in a lot of the shops out here in Singapore, or your gyro actually stopped. You have to wait for a while for gyro to actually come in place, and that was because Wirecard was stopped in Singapore. The other could be the regulatory risk. I think everybody will be aware of the stoppage of the IPO of Ant Financial. So what is this? It's probably not a problem of just Jack Ma, but the regulators coming out with new regulations for tech companies that are selling financial products. So with that, with our very short presentation, I hope to leave you with three messages. One, that the macro environment remains stable this year. The risk is not high this year. So as such, although the valuation of this sector is on the high side, is unlikely to derate. The second is that COVID has actually accelerated disruption. But these are long-term trends, and they are unlikely to reverse post-COVID. And lastly, investing in disruptive innovation is not all a bed of roses. It comes with it the risk. And it could be prudent for an investor to also consider investing in a diversified portfolio of companies. And lastly, I would like to introduce to you our Lion Global Disruptive Innovation Fund. The fund was created around 3.5 years back. It's done well. It's to give investors an opportunity to invest in 100 companies that are diversified across many countries and many of the themes that I have described. This will help investors minimize the idiosyncratic risk of investing in this sector while able to participate in the secular growth, the wonderful growth of these companies. Thank you.
Thank you, Lim Yuan. With prices having recovered from the March 2020 lows, it is time for investors to do some stock picking within the S-REIT space. Find out which S-REITs will shine in 2021 and which ones you might want to avoid. Up next, we have Yo Hui Shi, Equity Analyst, Stocks and ETFs Research, iFAST Singapore, to present Rest in Peace or Rage On. Is 2021 the year for REITs to shine?
Good evening, everyone. I'm Hui Shi from the Stocks and ETFs Research Team, and I'm here today to share with you our outlook for REITs in 2021. But before we go into that, let's first take a look back at how REITs have performed in 2020. So in 2020, we noticed that there was a performance divergence within the S-REIT sector. The data center REITs and the industrial REITs were the most resilient, while the remaining were being hit by COVID-19. Hospitality REITs were hit the hardest, followed by the retail and then the office REITs. But this is no surprise since COVID-19 it has grounded airplanes, hotels are empty except for the guests who are there to serve their stay-home notice. And as a result, hospitality REITs were the worst performing REITs of 2020. And that is not all. COVID-19 it has also changed the way we live and the way we work. And as a result, it has accelerated certain structural trends such as the shift towards e-commerce as well as the adoption of working from home. These trends, they have benefited the industrial as well as the data center REITs, but the exact same trends have also dragged down the retail and office REITs. On a more positive note, the share prices of REITs have recovered from their March 2020 lows, and the sector still has some way to go before reaching their pre-COVID levels. However, as share prices have been recovering, this also means that current valuations are not as attractive as they were as compared to the first half of 2020. And keeping in mind those structural trends which are changing our world, we believe that not all REITs are able to recover back to their pre-COVID levels in 2021. And so we believe that investors should be selective when investing in REITs in 2021. So now I'll be going through the outlook for the different sub-segments of REITs and highlight our stock picks for 2021. Let us first start with the hospitality REITs, which have been hit the hardest by COVID-19. Following a challenging year, the good news for hospitality REITs is that the rollout of vaccines will strengthen their recovery this year. In fact, billions of people are expected to be vaccinated in this year alone. However, we would like to acknowledge the point that it takes time for governments to reopen their borders, and so we expect a full recovery of hospitality REITs to extend beyond 2021. And the Singapore Tourism Board has estimated that a full recovery could take up to 3 to 5 years. But fret not, most of the hospitality REITs, they are backed by master leases. And under such master lease agreements, the REITs receive two different components of rent. One is a fixed rent, and the other is variable rent. Variable rent is dependent on the hotel's gross operating revenue as well as gross operating profit. And during the pandemic, with hotels being empty, the REITs have received little to no variable rent. However, they have continued to receive fixed rentals, which is independent of the revenue as well as the profit. And so this fixed rent actually serves as a downside protection and a minimum guarantee, which helps to limit the downside risk to the income of hospitality REITs while we wait for a full recovery. And looking further ahead, we would like to remind investors that the long-term catalyst of Singapore's tourism industry still remains intact. There are various tourism developments in the pipeline that will be able to support the continued growth of tourist arrivals in the longer term. And these developments include the expansion of Resort World Sentosa, the Mandai Nature Precinct, and the Jurong Lake District, just to name a few. And so we believe that investors should also be able to take a long-term view when it comes to investing into such hospitality REITs. There are various hospitality REITs out there, but our stock pick for 2021 is Ascott Residence Trust. Ascott Residence Trust has a large exposure to countries with sizable domestic markets, such as Japan, Europe, US, as well as China. It takes time for governments to reopen their borders, and so we expect that domestic travel will recover at a much faster pace as compared to international travel. And so we believe that ART will be one of the first hospitality REITs to reach its pre-COVID levels. We expect the DPU of ART to grow at double digits over the next few years, with a yield of close to 6% in 2022. And as you can see from this chart here, the share price of ART tracks its DPU. And with its DPU set to recover over the next few years, we believe that the share price of ART definitely has room for upside potential. And now I'll move on to the outlook for retail REITs, since Singapore has entered into the widely anticipated phase 3 of reopening. For retail REITs, we believe that those with suburban malls will be able to stay resilient. As Singapore has entered into the phase 3 of reopening, we believe that suburban malls will be able to recover back to its pre-COVID levels. I'm sure many REIT investors should be familiar with Fraser Centrepoint Trust, which predominantly holds suburban malls. And as of October 2020, the tenant sales of FCT have already recovered to near pre-COVID levels. And with the phase 3 reopening, we believe that FCT is well on track to reach a full recovery by the end of this year. Furthermore, suburban malls, they tend to focus on essential goods and services. And essential goods are more resilient against the competition from e-commerce. And this chart here shows that the online sales proportion for supermarkets, which is denoted by the blue line, had remained relatively stable in 2020, even during the circuit breaker period, which lasted from April to June. And in contrast, during the same period, you can see that other industries which are less essential saw a spike in their online sales proportion, suggesting that they are less resilient against the competition from e-commerce. And furthermore, apart from the focus on essential goods and services, suburban malls, they have a close proximity to densely populated residential areas. And we believe that this further supports their ability to be more resilient against e-commerce. And meanwhile, as compared to the suburban malls, we believe that downtown malls, they will face more intense competition from e-commerce, and they also take more time to recover. Downtown malls, they are more reliant on tourists as well as office workers. Borders, they will take time to reopen, and some office workers in the CBD are still working from home. And so we expect the recovery of downtown malls to lag behind that of the suburban malls. And also, unlike the suburban malls, which focus on essential goods and services, downtown malls, they face more intense competition from e-commerce. And as a result, we expect the rental rates of downtown malls to remain under pressure going forward. I'm sure many investors are familiar with CapitaLand Integrated Commercial Trust, CICT, which is the product of the recent merger between CapitaLand Mall Trust and CapitaLand Commercial Trust. And yes, CICT, it is currently the largest S-REIT, but there's one point that we are not so positive on about FCT, and that is the fact that it will be progressively taking on more risk from its tenants. Going forward, more of CICT's rentals will be charged based on the turnover of its tenants. So what this potentially means is that if its tenant sales remain weak, then CICT's income will be negatively affected. And we also need to keep in mind that CICT has exposure to downtown malls. And as I mentioned earlier, downtown malls, they are facing more intense competition from e-commerce. And so we see this as a negative for CICT, since there will be more downside risk to income that can be distributed to unit holders in the future. And hence, our stock pick for retail REITs is actually Fraser Centrepoint Trust. FCT holds a portfolio of resilient suburban malls, and we expect the DPU of FCT to rebound back to its pre-COVID levels by the end of this year, with a yield of about 5%. And once again, you can see that FCT's share price tracks its DPU, and so we believe that FCT share price has room for upside potential as well. And now I'll move on to the outlook for office REITs. With many of us working from home during the pandemic, it is safe to say that 2020 was not a good year for the office REITs. And even as we enter into the new year, the long-term outlook for office REITs still remains uncertain. Even as there are more employees who are going back to their offices during phase 3, there are also more companies who are starting to embrace working from home as a permanent arrangement post-COVID. And so we expect office demand to remain weak, with tenants either taking a wait-and-see approach when it comes to expansions or renewals. And for some, they may be asking for shorter and more flexible lease terms as they figure out their future office needs. And so we expect the occupancy rates and rental rates of office REITs to continue to fall this year. But despite all these negatives, there is still a bright spot within the office segment. And this bright spot is the healthy demand from the rapidly expanding tech sector. Tech companies, they have continued to lease office spaces despite them having work from home arrangements. And we believe that this can be attributed to the fact that they have been expanding rapidly thanks to COVID-19. So for instance, in the context of Singapore, the Chinese tech giants such as Tencent, they have announced that they are coming over to set up offices. And we believe that such positive developments can help to partially offset the overall reduction in office demand in Singapore. And over in the US, the story is similar. Tech giants like Amazon, Microsoft, they have continued to lease office spaces during the COVID-19 pandemic. And this is even as when they are allowing their employees to work from home until the end of this year, and for some, even permanently. And so this is why we think that office REITs with high exposure to demand from the tech sector should be able to fare much better as compared to its peers. And one such REIT is Keppel Pacific Oak US REIT, which is focused on the growing US tech hubs, such as Seattle, which is where tech giants like Amazon are headquartered at. Its largest exposure is to the city of Seattle, followed by Denver and Austin. In 2020, despite the COVID-19 pandemic, this REIT has managed to record positive double digits rental reversions, and this is mainly attributed to the new and expansion leases from the tech hubs. And looking into 2021, we believe that this REIT will continue to record positive rental reversions, but at a slightly smaller magnitude, possibly in the high single digits due to the economic uncertainties. And one interesting thing to note about such US office REITs is that they have built-in annual rental escalation. This REIT has an annual rental escalation of 2.7%, which means that the office rental rates under this REIT will step up by 2.7% every year. So this actually provides it with opportunities for organic growth and can help to cushion the impact from the falling market rental rates. We have a target price for Keppel Pacific Oak US REIT, which is at 79 cents, and this will translate to an upside potential of about 14%. And to add the icing on the cake, this REIT is yielding at a whopping 9% and is considered as one of the highest yielding S-REITs right now. And last but not least, we have the industrial and the data center REITs. 2020 was definitely a good year for them, but the question here is, can their resilient performance continue? And the short answer is yes. We believe that this industrial and data center REITs will remain resilient and will be able to continue to outperform the broader REIT sector in the longer term. And the growth of such REITs is mainly driven by structural trends such as the acceleration of e-commerce as well as the shift towards cloud services. The acceleration of e-commerce will drive higher demand for warehouse spaces, while the shift towards cloud services as more companies adopt remote working, as well as the future adoption of 5G will drive higher data traffic, and this will lead to a higher demand for data centers going forward. And one REIT that is well positioned to benefit from such trends is Ascendas REIT. Ascendas REIT holds a diversified portfolio of assets such as logistic properties, US data centers, and suburban office portfolios. Its logistic properties and data centers will be able to benefit from the structural trends which I mentioned earlier. One additional point to note about A-REIT is its suburban office portfolio. As offices are facing structural challenges, A-REIT has recently expanded its suburban office portfolio to include US offices, which are well positioned to benefit from the demand from the burgeoning tech and life science sectors. Tech and life science companies have continued to lease office spaces since they have expanded rapidly thanks to COVID-19. Moreover, A-REIT has a low gearing ratio, leaving a debt headroom of a whopping $4 billion, and this is enough for the REIT to make even more acquisitions to drive inorganic growth, and also to continue to future-proof its portfolio and to be a better reflection of the post-COVID economy. And we believe that this will be another catalyst that will drive A-REIT's growth in the longer term. We expect the DPU of A-REIT to remain resilient with its growth mainly driven by acquisitions as well as improvement in rental reversions. And we believe that A-REIT's share price has room for upside potential with a decent yield of close to 6% in 2022, which is considered as a bargain for such blue-chip industrial REITs. And so all in all, based on what I've shared earlier, the S-REITs are headed for an uneven recovery in 2021. And as share prices have recovered from their March 2020 lows, we believe that investors should be careful and also selective when it comes to investing in S-REITs going forward. With the rollout of vaccines as well as the phase 3 reopening, we believe that hospitality REITs and suburban retail REITs are well positioned for a recovery. The full recovery of hospitality REITs will take a few years, but for the suburban retail REITs, we believe that they will be able to reach a full recovery by the end of this year. And looking into 2021 and the years beyond, we believe that industrial and data center REITs will continue to deliver resilient growth. On the other hand, the long-term outlook for office REITs remains uncertain, but we believe that those with higher exposure to demand from the burgeoning tech sector will be able to fare much better as compared to its peers. And so this slide here summarizes our stock picks for REITs in 2021. The rollout of vaccines will support the recovery of hospitality REITs, but since time is needed for governments to reopen their borders, we believe that domestic travel will recover at a much faster pace as compared to international travel. And so our stock pick is Ascott Residence Trust for its large exposure to countries with sizable domestic markets. And for retail REITs, we believe that those with exposure to suburban malls will be able to stay resilient due to its focus on essential goods and services, as well as its close proximity to densely populated residential areas. And so our stock pick would be Frasers Centrepoint Trust, which has a portfolio of resilient suburban malls. And for the office REITs, even though work from home remains as a threat, there is still a certain opportunity within this segment. And this opportunity lies within the tech sector. As tech companies, they have continued to lease office spaces despite them having work from home arrangements. And so our stock pick will be Keppel Pacific Oak US REIT. And last but not least, for the industrial and data center REITs, we believe that their growth will be driven by structural trends such as the acceleration of e-commerce and the growth of cloud services. And so our stock pick is Ascendas REIT for its diversified portfolio of assets that includes logistic properties as well as data centers. And so this will sum up our 2021 outlook for REITs. Thank you for joining me in today's session. So now I'll pass the time back to the MC. Thank you.
Thank you, Hui Shi. Before we move on to the next presentation, do check out the unit trust promotion that FSM1.com is currently running. Receive $10 bonus units for every $10,000 invested in any of the 21 unit trusts from our top 5 markets and 4 mega themes. Which are these 21 funds? Head over to FSM1.com to find out. This promotion lasts till the 31st of January 2021. You can also, for a 6-month period from 8th of February 2021 to 31st of July 2021, enjoy a 0% processing fee when you transact via a regular savings plan. There's no better time to get started with an RSP. Open an FSM1.com account in just 5 minutes today via MyInfo. From the 9th of January to the 26th of January, open a new FSM1 account to receive 3,000 rewards points. To enjoy this promotion, you must click on the Promotions tab on the black menu bar and complete the form via the Account Opening Promotion form. Then click on Submit and proceed to Account Opening button to get to the FSM account opening page. If you know of somebody who does not have an FSM1.com account, now is the best time to get them to start one. Refer a friend to open an FSM1 account from today till the 26th of January, and you will stand to receive 3,000 rewards points for each friend, up to a maximum of 15,000 rewards points. Do note that if your FSM1 account was opened directly on our main website without submitting the form below, you will not be eligible for this promotion. Also, if you have any questions regarding the presentations today, leave them in the Q&A section by clicking on the Ask Question button, and we'll have our speakers take these questions later on today. On to our next topic, corporate bonds. And now it's time for our next topic. Corporate bonds have posted strong gains in the midst of a pandemic. Low interest rates, a weak US dollar, and aggressive quantitative easing measures by central banks have contributed to the rallies in 2020. Looking forward, 2021 may be one of the best years for fixed income. Listen in as we share how investors can use bonds to add diversification value to your investments to achieve better risk-adjusted returns. Help me welcome to this panel discussion, Dexter Tan, Senior Analyst, Fixed Income Research, IFA Singapore. Tan Chu Ren, Analyst, Fixed Income Research, IFA Singapore. And moderating this session is Sarah Chia, Business Development Manager, Bond Supermart, IFA Singapore.
Hi everyone, I'm Sarah from the Bond Supermart team. Thanks for joining us this evening. So today we'll have Churan who will take us through the three sectors that we are particularly keen on for 2021. So Churan, could you please?
Okay, right. Thanks, Sarah. So one of the sectors that we are positive on is the airline sector, which we think can take flight literally and figuratively in 2021. And when tourists return to travel, hospitality sector is one of the sectors that can stand to benefit too. And lastly, we are ever positive on the Chinese real estate sector, which you can always find high yields for your portfolio. So firstly, the airline sector. For airline sector and travel sector to take place or to recover, we need vaccinations to take place as quickly and as large a scale as possible. Experts have this, so if you've been reading the news, then you have read about the new COVID-19 variants in the UK or in South Africa, where they're spreading across the countries. But fret not, experts have been saying that the current vaccines can fight off the new COVID-19 variants. And experts across various countries are also saying that we need about 80% of the population to be vaccinated in order to hit herd immunity. So the most important factor for the path to recovery will be efficient distribution of vaccines. If you look at the US aimed for 20 million people to be vaccinated by the end of 2020 and another 20 million people vaccinated by the end of January. If you look at the start of January, they were very far off with only 4.23 million people vaccinated, way off their target. At the current pace, they can only hit herd immunity in 2.5 years. If they vaccinate about 20 million people per month, then they will hit herd immunity in about a year. So these are rookie numbers, and US has to bump these numbers up. Hopefully Biden's administration can quicken things up and hopefully vaccinate about 1 million people per day and allow US to hit herd immunity in about 9 months. At home, our government also expects enough doses for everyone by the third quarter of 2021. Optimistically, we think that maybe most of international travel can recover by the first half of 2021, and most of the people can be vaccinated by the third quarter of this year. So before that happens, we'll be able to see regional travel bubbles. For example, the ASEAN travel bubble or Asia Pacific travel bubble, where we are combating COVID-19 better than our Western counterparts like the Europe or the US. Furthermore, financial markets are forward-looking. So signs of distribution going well will lay foundation for tourism-related companies or the real economy companies to perform. And prices may move or are already moving ahead before mass-scale vaccinations take place. So looking at tourism data, the numbers have really fallen off the cliff in February 2020. Most countries have started to open up selectively, for example, like Thailand, where they can't bear the economic loss. However, new waves of COVID-19 infection can stall the opening, for example, what we see in Hong Kong in July 2020. So for travel sector or airline sector to recover, we need more vaccinations to take place. So we have one company for you, which is Cathay Pacific Airlines.
Yeah, thank you, Churan. So as the rate of vaccinations improve and catch up with the rate of infections, we think there's a meaningful turnaround. So we are positive on the airline sector. So one of the names within the airline sector that we like is Cathay Pacific Airways. So it's the flagship carrier of Hong Kong. And if we look at the revenue geographically, most of it is actually derived from Hong Kong and China, which made up about 50% of its 2019 revenue. So looking at its operating segment for the first half of 2020, we see that revenue is equally distributed between cargo services as well as passenger services. If we compare its performance for the first half of 2020 versus the first half of 2019, we see that the performance revenue has actually dropped, especially for passenger services. But if we look at the cargo services, it's actually improved from 11 billion to about 12.7 billion. So we are fixed income investors. So for fixed income, we usually look at the balance sheet. So even though our revenue has actually dropped, but we look at its balance sheet, looking at its current, the amount of sources of liquidity that's available to the airline versus its current liabilities, that would be interest-bearing liabilities. We see that the amount of sources of liquidity that's available to the company is significantly higher than its short-term debt. So this would consist of its unrestricted liquidity as well as its recapitalization plan and interest in its associate. Its investment in its associate. So look, to explain its investment in its associate, it's actually a 18% stake in Air China. So Air China is actually a listed entity. So if need be, they can actually sell their stake in Air China to actually meet its bond obligations. So to explain its recapitalization support, the Hong Kong government has actually pledged 27.3 billion to the airline, and this would be made up of its preference share subscription as well as its bridge loan facility. The airline has actually issued rights, and the major shareholders, Swire Pacific, Air China, and Qatar Airways, has pledged to actually take up a pro rata share of the rights issue. So this is positive for Cathay Pacific bondholders. So the pro forma impact, according to the company, is that total equity will actually improve from 49 billion to about 80 billion. And net financial debt would fall from 93 billion to about 61 billion. If we look at gearing, which is an important aspect for credit, gearing is projected to fall pro forma from 1.88 times to about 0.7 times. So within the capital structure of the airline, so we are looking at bonds here. So the bond that we're recommending is the 3.375% 2023 bond. So it matures in January in about 2 years' time. The spread, as we can see, which is the valuation above the risk-free benchmark, is about 530 basis points. So this bond is actually available on Bond Express. So Bond Express is a platform that we have whereby it allows accredited investors to buy bonds which are as low as $5,000. So looking at the yield to maturity here, which is about 5.6%, we see that so the G spread actually translates to a yield to maturity of about 5.6%. And this means that if you buy the bond today and you hold it to its maturity, the annualized rate of return before fees will be about 5.6%.
So Dexter, when it comes to these airline carriers, aside from Cathay Pacific, are there any others that look attractive right now? Let's take our national carrier, SIA, for example.
Yeah, so I think, we also like SIA. So SIA is our national carrier, and the government has actually pledged support for the airline. So yesterday, they raised, I think, like $500 million through a bond offering. So that's also positive for SIA. But if we compare the yields of SIA versus the yields of Cathay Pacific, I would say the retail bond by SIA is the 3.03%, 2024 bond, so it has a yield to maturity of about 2.9%. So that is like lower than Cathay Pacific's bond. So, but I think both airlines are still attractive to us. Of course, if you buy the Cathay airline, then the bond you will get a higher yield. Yep.
Yeah, that's quite a huge difference in terms of yield. So I guess I see why you've chosen to present on Cathay Pacific today. So Chiran, could you take us through the next sector?
Right. So when tourists travel, accommodations play a huge role in their vacation. So we'll also take a look at hotels. So using Singapore as a reference, the hospitality sector was barely hit last year. Hotel occupancy rate was about 30+% lower than the average hotel occupancy rate in previous years. Furthermore, historical average room rate was about twice of that in 2020s. So naturally, hotels have really taken a huge hit in their earnings. If destinations and travel were to get going, then hotels' revenue will also naturally recover. So we have one name for you, which is Ascott Residence Trust.
Yes, thank you, Chiran. So yeah, I think this name was actually mentioned by Hui Shi earlier. So yeah, we also like the bonds of Ascott Residences Trust. So maybe I'll just give you a brief overview of the company. So it's the largest hospitality trust in Asia. So there are 88 properties in operations in across 15 countries. So it's owned by Ascott Limited, which is a wholly owned subsidiary of CapitaLand. So CapitaLand is a name which we all are familiar. So Temasek actually has a 51% stake in CapitaLand. And what this means for bond investors is that if need be, there is a possibility that Temasek may actually inject capital into the company because there's an indirect link in CapitaLand. So lastly is that Fitch Ratings has actually assigned a BBB rating to the senior unsecured debt. So Ascott Residences Trust would be a borderline investment grade company. So here we have the credit highlights of Ascott Residences Trust. So these are important for bondholders or potential investors. So here we have the gearing, which is about 34.6%, and this is the debt to total asset ratio, meaning that the trust may actually raise additionally 2.2 billion. Secondly is that the interest coverage ratio is about 2.9 times. So this is higher than some of its competitors, peers in hospitality, which will be Frasers with about 0.9 times or CDL with about 1.9 times. So 69% of the property is unencumbered, meaning they can actually pledge more securities to pay down, to raise debt and pay down its existing debt. And lastly is that there's 885 million of available cash that is available to the trust. So this is significantly higher than its 571 million of short-term debt. So looking at this debt maturity profile, they already refinanced their bonds that were already due last year. So what we have left is about 338 million. So as you compare this number to the previous number, which is the liquidity 885, so this is 885 is much higher than 338 million. So it means that the company has a very adequate liquidity profile. So we get within the capital structure, we like the Ascott Residences Trust 3.07% perpetual note. So this is somewhat different from a typical fixed rate bond. So this, as the name implies, there is no maturity. So the coupon rate is about 3.07%. So right now it's trading at a ask about 97.8. So at a ask of 97.8, the yield to call for this year is about 7.8%, and the yield to call in December is 5.4%. So this perpetual security is actually, it allows the issuer to redeem the note on its call date. So it doesn't have maturities, but the issuer can actually redeem it on its call date. So if you look at the valuation, it's quite attractive. Of course, if the note falls to about 95, then it becomes more attractive at 13.8%.
Right. So Dexter, I definitely believe in the eventual revival of the hospitality industry, but could you give us, say, 3 really quick points on, why Ascott Residences Trust instead of other hospitality chains?
Yeah. So number one is that Ascott is as I mentioned, is the biggest hospitality trust in Asia. Secondly is there's an indirect link to Temasek. So, and thirdly is a high interest coverage ratio. So this is higher than its peers like CDL Hospitality or Fraser's Hospitality. So those are the 3 points, which is why we also like Ascott Residences Trust.
Okay, that was 3 very compelling points. So now over to you again, Churan, for our third and final sector for tonight.
All right, so last, Chinese real estate sector, one place where you can always get high yields for your portfolio. However, they weren't unharmed by COVID-19 too. So developers have seen gross profit margin declining, especially in the second half of the years, due to them running their year-end discount sales promotions. So COVID-19 could have depressed their profit margins as well, and it's likely that profit margin will likely remain pressured for second half of 2020 and possibly even first half of 2021 too. However, we remain optimistic for this sector because monthly contracted sales have rebounded strongly since the February lows and is on the path to positive growth for the whole of 2020 despite COVID-19. Developers are also still continuing to invest with yearly cumulative real estate investment increasing by 6.8% year-on-year as of November 2020. Although it's positive, this number is still lower than the historical average, showing the impact of COVID-19. However, the Real Estate Climate Index, which is a consolidation of 8 key statistics, is back to expansionary territory, which is above 100. Although it dropped to a low of 97.44 in February 2020, by Chinese standards, it is still a moderate level. This rebound also shows that developers continue to hold a positive view on the real estate sector. So looking at prices, spreads have also come down from last year's March highs, but we still continue to like Chinese real estate bonds, especially the B-rated ones. So we like high-yield bonds that are maturing within 3 years, and we have one for you, and it's not Evergrande.
Yep, so it's not Evergrande, it's actually LVGEM, China Real Estate Investment Company. Maybe just to give you more information about this company, LVGEM China is one of the developers based in Shenzhen. So it's recognized as one of the top 10 enterprises in terms of comprehensive strength for 10 years. So this is from 2011 to 2020. So at the end of June, the group actually completed 24 properties with a gross floor area of about 3.7 million square meters. So this is smaller than other real estate like players like China Evergrande, which has 293 million square meters of gross floor area, or even Logan, which has about 39 million square meters. So this is a smaller developer. So Gemstones International is a wholly owned subsidiary and the bond issuer. So looking at its land reserves breakdown, most of its land reserves are actually located in Maoming and Shenzhen. So these areas are actually within the GBA, or I would say Maoming is actually on the fringe of the GBA. So what is the GBA? GBA is actually a fast-growing area that is in China, linking Hong Kong as well as Macau. So the country actually aims to grow this area to rival other Bay areas. So we will expect that the urbanization rate will pick up in future years. So as the urbanization rate picks up, so this is actually positive for Chinese developers who have properties within this area. So looking at its future developments, again, most of it is in Maoming and Shenzhen. So Shenzhen, as I think most of us know, it's actually a tier 1 city. So the properties there are very highly priced, and there's great demand, and usually the assets are more liquid. So looking at its sources of liquidity again for fixed income, so we always tend to focus on these sources of liquidity that the company can actually use to pay down its debt. So there's investment properties, a cash balance, as well as some properties that they can sell actually to meet its obligations. So what are these investment properties? So these will be, I've listed them here. So these will be some of them shopping malls located in Shenzhen, Huazhou, and Suzhou. So moving on to the other investment properties, they would be, some of them are office towers in Shenzhen as well as in Hong Kong. So in the middle column is actually the original cost, and the far right column is the fair market value of these properties. So if we add the fair market value, it means that this is the amount of liquidity that is available to the company that they can use to pay down its debt. So if we measure the difference between the middle column and the far right column, it's actually, you can tell that they bought it at a very low cost, and right now the market value has appreciated a lot. So it meaning there's a lot of unrealized gain that the company can actually potentially receive. So the bond that we are recommending is the LVGEM 12% bond that is maturing in 2023. So the valuation is about, the G spread is about 1,200 basis points above the risk-free rate. And that would translate to a yield to maturity of about 12.3%. So I would say this is an attractive bond, and it's also available on a Bond Express. So you can actually buy this in very small denominations of $5,000.
Right, so Dexter, now my question is, there are so many Chinese real estate developers out there. In fact, I think more than a third of Asian high-yielding credits are actually made out of Chinese real estate firms. So how did you decide on LVGEM? And back to what you and Sharon were talking about just now, why not China Evergrande?
Okay, so that's a good point. Yeah, so I think most people have heard of China Evergrande, but not many people heard of LVGEM. So if we look at the valuations, so China Evergrande, I think some of their bonds are trading like 15%. But if you look at China Evergrande's cash to short-term debt, it's about 35%. Whereas LVGEM the bond is trading about 12%. So, but the cash to short-term debt is about 70%. So it's higher. So I think LVGEM has a better risk reward, in my opinion. So secondly is most of LVGEM's land bank is actually located in GBA, whereas China Evergrande is mostly in Tier 2 or Tier 3 cities.
Right, you make a very fair point there. And I guess aside from serving as an alternative to Evergrande, LVGEM is also on Bond Express. So that provides some pretty good diversification benefits if you are investing in the Chinese real estate sector. So Dexter and Sharon have shared 3 sectors that they're keen on for 2021. We've got airlines, hospitality, and Chinese real estate. They have bond recommendations for Cathay Pacific, Escort Residence Trust, and LVGEM. And of course, this isn't all that we are keen on. We have also just launched our first half 2021 recommended bonds report with 55 issuers and over 100 bonds that you can look at for bond ideas. So in line with this year's FSM What and Where to Invest, we have also coordinated a special promotion for you. We have reduced our processing fees from 0.35% to 0.21%, and it has just started today and will end at the end of the month. So again, if you need bond ideas, consider the 3 sectors that we just discussed and check out the recommended bonds report. If you have any questions for us on the bonds team, you can actually check in with Dexter during the Q&A session later, or simply contact our FSM investment advisors. So thank you again for joining us tonight. We'll pass our time back to our MC.
Thank you, panelists. Up next, we have Yo Wei Ren, Manager, Stocks and ETFs Research, IFA Singapore, who will share about 3 ETFs you should know to invest in the future of technology. Wei Ren, please.
Good evening, everyone. Thank you all for joining us today at What and Where to Invest 2021. My name is Wei Ren. I'm actually part of the research team at FSM1. And today, the main topic of my sharing is on technology. And specifically, I want to highlight 3 ETFs that you should know about if you want to invest in the future of the digital economy. Now, I know that we have been talking about technology and digital economy for the longest time throughout 2020, and also I think last Saturday you have perhaps heard from my colleagues about investing in the digital economy. But there's a very good reason why we always talk about the digital economy, and the reason really is this. It is because of the fact that the digital economy is a massive market. If you look at the market size of the digital economy, it's actually valued at about 9.5 trillion US dollars. And if you treat the digital economy as a standalone national economy, then it is actually currently the 3rd largest economy in the world right now, just behind the US and China. And within it also lies a lot of investment opportunities for us. But every time when we talk about technology and the digital economy, I think a lot of investors, they tend to associate technology with things like e-commerce, and social media. But the digital economy is really more than just that. Not only are digital economies present in the e-commerce space and as well as the digital media space, digital technologies are also present in lesser known industries such as the travel industry, finance industry, as well as the healthcare industry. Which is why today I wanted to spend some time to talk about 3 ETFs that give you very specific exposure to these lesser known areas of the digital economy. And the first ETF that I want to talk about today is actually something that my colleagues have already talked a lot about today. I want to talk about the travel industry. Now, I think some of my colleagues have talked about investing in airlines, investing in hospitality REITs, and today I want to propose another way for you to play the potential travel recovery in 2021, and that is using a travel technology ETF. Now, the reason why I want to talk about travel industry is because travel industry is one of those industries that has been badly hit by the COVID-19 pandemic. But with the distribution of the COVID-19 vaccines, then a lot of investors are expecting 2021 to be a vaccine-driven economic recovery. And this is also a view that FSM1 has, and which also brings me to my next point, which is that the travel industry is also going to be one of the main beneficiaries of this vaccine-driven economic recovery in 2021. Now, the recovery has in fact already started. Okay, if you look at this particular chart over here, if you look at traveling activity at the global level, it has in fact started to recover. Of course, we are still far off from pre-COVID-19 levels, but the fact is people are starting to travel. And but of course, if you look at the recovery in across the different key markets in the world, the recovery has so far been very unbalanced because certain markets have actually experienced a very fast rebound, but there are also certain markets that continue to face challenges. So I think a case in point right now is the US and Europe travel markets, which are facing second and maybe even some facing their 3rd waves of COVID-19 infections. And also between the domestic market as well as the international travel market, the recovery has so far been driven by a recovery in domestic markets. And at this point, I just want to bring up a very good example of how domestic traveling markets has actually been spearheading the recovery in global travel. And the example that I want to bring up is actually the Chinese domestic travel market, which has been leading the recovery in global traveling activity. Because if you look at this chart over here, if you look at the level of traveling activity on domestic routes within China, as indicated by the blue line on my slides, you can see that the level of rebound has actually been very strong, to the extent that it is about 90% of pre-COVID-19 levels. But of course, if you look at the traveling activity on international routes, then of course, the traveling activity on international routes, it's really far more muted. compared to the domestic traveling activity. And the reason for that is because I think China has done a really good job in containing the COVID-19 situation within the country. But outside of China, I think the COVID-19 situation is really more uncertain. And also because of the fact that if you were to travel outside of China and if you come back, then you will have to serve a compulsory quarantine. And a lot of Chinese travelers, they actually do not want that, which is why a lot of them are actually opting for traveling on domestic routes. And some pictures over here. If you have attended a couple of my presentations back then, I have actually showed these pictures before, but I'm going to show them again just to illustrate the fact that I think people are starting to travel within China, and even people in Wuhan, which is the place where COVID-19 started. People are also starting to travel as well. And my main point really is this. I think people at the bottom of their hearts, they actually do want to get out of their houses. They actually do want to travel. And the reason why they are not traveling right now is because they are really fearful of contracting the COVID-19 virus. And that is perfectly understandable, which is why the discovery, or rather the rollout of vaccines worldwide, I think that is going to be a game changer for the travel industry. Besides the availability of vaccines, there is also going to be a potential large-scale rollout of rapid test kits that will complement the world government's public health responses to the COVID-19 pandemic. And all these together, I think it bodes well for the travel industry, because I think travel will eventually resume. I think the question now is when will it resume? So we don't think that travel will stage a very strong rebound in 2021, but we believe that the recovery will continue into 2021, and this is going to be a positive development for travel-related stocks. Now, where does technology come in all of this? Technology comes into the travel industry because travel industry is one of those industries that is experiencing a lot of digital disruption. So one of the ways the industry is being disrupted is the fact that a lot of travel bookings of hotels, of airline tickets, of tour packages, they are gradually shifting from the offline space into the online space. And in fact, if you look at some of the market forecasts out there, they are actually predicting an annual growth rate of about close to about 11% over the next 3 years. And that is a forecast of recovery for the online travel market. And also in other ways, technology has been playing an important role, such as the use of artificial intelligence to make personalized recommendations to consumers, and also the use of augmented reality to help enhance the overall travel experience for travelers. And also, one of the major breakthroughs in digital disruption in travel industry is that the availability of technology has actually enabled the sharing economy. So companies like Airbnb, Uber, and Lyft, these are all enabled by the onset of the digital economies. And of course, in the longer term, beyond the immediate 3 years, if we look beyond perhaps over the next 10 years or maybe even 20 years, I think the travel market is going to grow. And emerging markets, they are going to be the key growth drivers. And when I say emerging markets, I'm really talking about China as well as India. But I think a more interesting statistic that I want to highlight in this particular slide is the fact that a large proportion of travel bookings in emerging markets like China, they are actually still being made in the offline space. And that is largely due to a lack of sufficient internet access, which also means that as the internet infrastructure in these emerging markets improves, then as people get connected to the internet, I think people are going to start shifting their purchasing of travel packages from the offline space into the online space. Now, if you buy into this long-term growth story, and also if you want to look for ways to play the travel recovery in 2021, then here's one recommendation for you, which is the ETF MG Travel Tech ETF. And if you look at some of the main companies and also main sectors within this ETF, you are actually investing in companies that are related to travel bookings and reservations, and also ride-hailing and ride-sharing companies. So if you look at the top companies, I think some of them are perhaps very well known to all of us. Booking Holdings, Airbnb, Trip.com, and if you look down the list, then you also see ride-hailing companies like Uber and Lyft. So one ETF for you to consider. And another ETF that I also want to bring to your attention today is the ETF MG Prime Mobile Payments ETF. And the reason why I want to highlight this is also because of the fact that I think financial services is also another area that is undergoing rapid digitalization. I think it has really changed how financial services firms interact with their customers. And also after COVID-19, I think it is imperative and very critical for financial services firms to be able to still conduct business with their customers in the online space, because you never know when the next health crisis like COVID-19 is going to hit the world again. But financial services is actually a very big area. You have got your digital payments, crowdfunding, peer-to-peer lending. The list goes on, but if you look at some of the biggest and the fastest growing areas within financial services, it is actually in the area of digital payments, which is also the key focus of my presentation today. Now, I think digital payments is an area that is expected to see very strong growth. I think there are a couple of reasons why we should be optimistic over the long-term prospects of digital payments, because I think digital payments has actually been a game changer, especially in the retail space. On the part of consumers, I think digital payments has really made payments very seamless and very easy. For businesses, being able to offer a lot more payment options, including digital payment methods, has also seen them being able to capture new customer segments. And also governments worldwide, because of COVID-19 and because of the fact that physical cash can be a potential medium to transmit the virus, I think governments are also encouraging citizens to adopt digital payments as well. And also I think the MAS has recently come out to say that they encourage all of us in this upcoming Chinese New Year to give ang paos using digital methods. And the reason for that is not just because of COVID-19, but also because of the fact that physical cash actually is, it actually comes at an environment cost, which also means that as we shift to more sustainable solutions, as we, as governments across the world try to tackle climate change, then what we are likely to see in the future is a gradual shift from physical cash into cashless payment methods. And also some interesting facts about the state of cashless payments in selected countries in the world right now. I think by and large at the global level, we are still very much a physical cash society. Of course, I think some markets have actually made very significant progress in moving its population to digital payment methods. I think the US has done a great job. China has also done a fantastic job in advancing its digital payments industry. But even then, even with all the efforts that it has made over the years, about 40% of China's payments still come from physical cash payments. And of course, interestingly and also shockingly, Europe and Japan, despite being at the forefront of technological innovation, these two are actually markets that have a significant proportion of their payments using physical cash. So in terms of the market potential for digital payments to come in, I think the potential is there, and especially since we are going to see a gradual shift from physical cash to cashless payment methods. And another key driver of the adoption of digital payments is really e-commerce. Not only are more people adopting e-commerce because of COVID-19, the existing people who are using e-commerce before COVID-19, they have also started to use a lot more of e-commerce services to do their shopping. So this increase in e-commerce activity, I think it is going to be a major driving force for digital payments adoption in the future. And also another factor is really there are a rising number of payment options. I think in these days, coffee shops and hawker centers, they also need to offer digital payment methods while at the same time also accepting physical cash. And being able to offer a number of payment methods. I think for the businesses, it allows them to capture new customer segments. And being able to offer these complex web of payment options also requires businesses to work with third-party fintech firms. And therein lies the opportunity for fintech companies. I think in the future, I think payment firms, they will definitely be entrenched as an essential component of retail businesses. So this is how the future of mobile payments is going to be like. I think the future of mobile payments is going to be driven by the millennials. Physical cards are probably going to go away because we can store this information easily in our mobile phones. And we can also now use wearables to pay for our purchases at retail outlets. And also in the very near future, payment with a selfie, fingerprint, or a very simple retina scan, it is going to be the norm in the world of payments. So if you would like to capture this growth in the area of digital payments, then of course this ETF is something that you can consider, which is the ETF MG, Prime Mobile Payments ETF. Now if you look at the breakdown of this particular ETF, the key companies inside, the card network companies are all inside, including your MasterCard, Visa, Amex, and at the same time, there is also quite a fair bit of exposure to payments processing companies and also the companies that offer hardware as well as software solutions that enable this entire digital payments ecosystem. So another ETF for you to consider. And the last ETF that I want to talk about is really this telemedicine and digital health ETF. And again, the reason for that is because of COVID-19, because I think COVID-19 has really brought, has really disrupted the healthcare space, and it has in fact driven massive adoption of telemedicine because of the fact that COVID-19 has actually put a strain on all aspects of the global healthcare system. And I think China, in fact, has started to encourage its population to start adopting telemedicine solutions because of the COVID-19 pandemic. So if you look at some of the very popular telemedicine platforms in China, adoption rates on these platforms has actually increased by many folds. And I think in the future, telemedicine and digital health solutions, they are going to transform the healthcare sector. Not only because it helps to facilitate safe and effective patient care from afar, but also because of the fact that I think healthcare, on the part of individuals, for consumers, they are starting to prefer treatment methods that come with greater effectiveness as well as convenience. So being safe and effective also comes along with convenience for telemedicine solutions. And also, I think in the near future, healthcare will increasingly take place across a variety of locations between the hospital and the home. And I think this shift in healthcare towards digitalization is going to be driven by a couple of factors. Increased connectivity is one. I think people are also living longer, which means that your future healthcare demand is going to increase exponentially. Whether or not the supply of hospitals, healthcare facilities and healthcare professionals can catch up to this demand, but I do feel that telemedicine services can come in to help meet some of this increase in demand that is associated with an aging population. And on top of that, in our world right now, there is actually unequal access to healthcare services, especially if you are talking about the rural areas. So the rural population in our world right now, they actually do not have convenient or easy access to healthcare facilities. And I think telemedicine and also digital technologies can really help to bridge the gap between healthcare solutions and our rural population. And last but not least, I think digital technologies can also help to improve the efficiencies in our global healthcare systems. Now, a bit of introduction to some of the key players within the telemedicine space. I think some of the key companies, you might have heard of them before. Ping An Good Doctor, it is currently one of the leading players in the world right now in terms of the telemedicine space, largely because of the fact that it is operating in China, which has the largest population in the world right now. And along with Ping An, there is also companies like Teladoc, which operates mainly in the US and is also the largest telemedicine platform in the US right now. Okay, but of course, if you look at the key areas of opportunity in digital health, it is really more about just telemedicine. Yes, telemedicine, I think, is one of the areas that we should be looking at in terms of areas of opportunity in digital health. But the fact is that there are also opportunities in healthcare devices as well, especially in devices that are connected to the internet and devices that automatically transmit data to the patients and to physicians. And that actually enables physicians to monitor high-risk patients from a distance and also helping them to deliver better treatments to their patients. Analytics is also another fast-growing field. Healthcare companies, they are increasingly leveraging on data analytics to improve the delivery of healthcare services. And I think examples in this will include the use of AI, as well as data analytics platforms to comb through large amounts of data that is in the healthcare space right now to try to come up with better treatment methods, better testing methods, and also to deliver better clinical outcomes for patients. Okay, so if you want to invest in the telemedicine and the digital health space, there is currently only one ETF that you can consider listed on the NASDAQ, which is the Global X Telemedicine and Digital Health ETF. So if you look at the top 10 companies, you will realize that the telemedicine companies that I just highlighted, they are not inside the top 10 holdings. Fret not, they are actually inside the ETF, just that they are not the top holdings. So what this ETF actually invests in is actually not just the telemedicine service platforms, but also companies that manufacture healthcare devices and also companies that are involved in healthcare technology. So if I may go back to my previous slide, so a lot of the companies that are in this ETF, they are actually involved in the area of healthcare analytics. So one ETF to consider if you want to invest in the future of telemedicine and the digital health space. And this actually brings me to the conclusion of my presentation today. I have actually shared 3 ETFs that you can consider for your portfolios in 2021. And I hope you're as excited about me as the future of digital economy, as well as the 3 ETFs that I have highlighted today. And once again, I'd like to thank everyone for tuning in to What and Where to Invest 2021. Thank you.
Thank you, Wei Ren. We'll now take a short break as we head over to our speakers at the Q&A panel. If you haven't already done so, you can leave your questions regarding the presentations for today in the Q&A function. We'll see you shortly. Welcome back, everyone. Joining us here on the panel to take your questions will be Rasmin Ang from the Fifth Person, Lim Yu In, Fund Manager, Disruptive Innovation Fund at Lion Global Investors, Yo Hui Shi, Equity Analyst, Stocks and ETFs Research, IFAS Singapore, Yo Wei Ren, Manager, Stocks and ETFs Research, IFAS Singapore, Dexter Tan, Senior Analyst, Fixed Income Research, IFAS Singapore. And moderating this session is Sean Tiao, Senior Analyst, Unit Trust Research, IFAS Singapore.
Good evening, everyone. Thank you so much for staying with us thus far. Tonight, I'm joined with my panelists over here today, who'll be answering some of the burning questions that you might have for them. So you may participate in the Q&A by upvoting the questions that you would like to be answered the most. We could submit new ones if they have not been submitted yet. So without further ado, let us get started. And I think the key thing that I've noted from the question is that there's a lot of growth-related questions. And I think this gels really well with our earlier poll, where I think 50% of our listeners today, they are basically going for growth. So I guess the first question to really start things going is basically the question, should investors look for growth or value in 2021? Should we overweight value versus growth? And perhaps this question will be open to the floor, but perhaps I'll invite Rasmin to just share his thoughts with us.
Yeah, I think the year of 2020 is pretty much, as I've shared with you guys, is a year of a lot of growth stock have actually done really well. So generally, I feel that growth stock over the next 3 to 5 years, you do not expect them to do as well as compared to the year of 2020. They generally, if you invest in some of the good growth stocks, they should continue to do well over the mid to long run. But next 2 to 3 years, I think it will be a lot harder, right? So I see more opportunities now looking for those stocks, especially those income stocks that have actually been paying out very stable dividends, and they have been rather resilient because of the COVID-19, right? And yet they still continue to pay the same dividend, if not even higher. Okay, so the mixture for, I do have personally both income and growth portfolio. I am deployed quite a bit during the year of 2020, mostly growth stock. But in the income stock, I also increasingly started to deploy because those are the stocks that actually pretty much lag behind in the year of 2020.
Yeah, I think you mentioned a good point about some areas of growth being expensive, and I think that includes tech and perhaps disruptive innovation. Yeah. So I guess for Lim Yu In, since you are the fund manager for the Disruptive Innovation Fund, what are your thoughts about the high valuations, and should investors continue considering such themes for their portfolios?
Okay, I think there are probably 2 things to consider over here. One is the valuation is actually on the upper end of the historical range. So what is actually causing this? I think the important thing is actually the low interest rate. So if you take a look at the so-called the earnings of a company throughout its whole cycle, when rates are low, whatever that is in the future, you discount it over a very low rate, and as such, when rates are low, the valuation of growth companies tend to be high. So actually going back to your previous question, growth or value, I think over here you can actually adopt, our listeners can actually adopt a barbell approach. What do you mean by barbell? Because on one hand, the rates are expected to remain low for the foreseeable future. So which means that valuation will stay at a high end, albeit there's no major risk in the macro environment. So as such, then the next step is to look at the earnings growth of this company. So if you look at the Lion Global Disruptive Innovation Fund, within our universe itself, within our portfolio itself, the earnings growth for this year is very reasonable at 22%. So if you think about that, if these stocks don't derate and earnings are still strong, well, there's no reason to actually avoid these stocks, which people will consider as growth. On the other side, for value, not all value stocks are the same. So if rates are low, then what are expectations for financial stocks like banks that actually would depend on interest, income, which actually is a function of the interest rate, right? So when you talk about value stocks, there are different buckets of value stocks. Value stocks in the industrial side will actually do well. Incidentally, the Lion Global Disruptive Funds also invest in some of the industrial stocks that are actually innovators. So if you are doing a portfolio, you could actually consider doing a barbell, meaning you invest in value stocks with good potential in the near term, and also growth stocks that continue to see strong growth in earnings.
Yeah, you mentioned a good point about some of the good points about value. I do want to get back to that, but before I do so, I think I just want to clear the question with the largest upvotes right now. And I think that's in relation to the ARK ETF that I think Rasmin mentioned earlier in his presentation. So the question is it too late to enter into the ETF right now?
I'm not an expert in the disruptive so-called stocks, those stocks that are actually bought by ARK ETF. So I don't really have comment on that. But they have done exceptionally well, because I think 2020 we saw a lot of Robinhood investors bought the same basket of stock, and that kind of pushed up the valuation to sky high, right? And I think there are certain stocks that are in the bubble territories, but there are also certain stocks that even in the high growth industry, and yet they are trading at a lot more reasonable valuation. And those are stocks that you can still look at, right? So for example, I think Amazon is probably one of them. And I probably won't go into those companies that are still loss-making and they're trading at a sky-high kind of valuation, right? So I'm pretty much a bottom-up investors, yeah.
Is it okay if I chime in on
Sure,
that particular
go ahead.
question? I think the ARK ETF, even though it is an ETF, it is actually an actively managed strategy.
Yeah.
So the portfolio manager behind this ETF is actually Katie Woods. And as we all know, Katie Woods has done exceptionally well in 2020. So my advice to investors who are wondering whether to go into this particular ETF or not is that when you assess active strategies, you should assess the ability of the fund manager to continue delivering consistent outperformance. So in 2020, we have seen Katie Woods picking, big winners like Tesla. Of course, I think some of us are debating whether Tesla is overvalued and whether it is a good time to enter in this particular ETF right now. But the truth is, if you want to invest in ARK, then you are actually putting your faith in the ability of Katie Woods to assess the valuation of these companies. And if Katie Woods has had a good track record of doing excellent stock picking in the past, then of course, whether valuations are cheap or expensive in the digital space, then I believe Katie Woods certainly has the ability to outperform the market again. So if you believe in Katie Woods, I don't think you should care about whether markets are expensive or not, because you are investing in, ultimately in the stock picking ability of the portfolio manager.
I like that you mentioned that the ARK ETF is actually actively managed strategy. Well, on the other hand, I believe the Lion Global Fund takes a different approach. Maybe you want to share with us like why and perhaps who is it best suited for? Yeah.
Okay, the Lion Global Disruptive Fund, maybe I can actually explain how we do the portfolio construction itself. It's actually a smart beta fund, right? So the idea generation part is when we actually identify the disruptive innovation trends that are relevant. So we come up with 16 trends over there. And actually we'll constantly monitor and make sure that the trends are actually relevant, and then, these are actually chosen. And with this, we actually go out and scout with all these trends, which are the beneficiaries out there, and we come up with a universe. And subsequently, what we do is that we apply a 5-factor model, which is the smart beta part, that has got all the characteristics that people would value in the disruptive stocks. For example, market cap. It must be a large cap because winners take all in this space. Price to sales because of valuation. You do not want a replay of 1999 and 2000 whereby companies that are too expensive, in a crash drops a lot. Then earnings growth and sales growth over the next 3 years because you want to see growth. If it's a real disruptor, you want to see growth. And lastly, volatility. So by doing so, we do our portfolio construction of 100 stocks. So how is this actually different from others? Ours, we actually created a product with risk in mind. meaning that you want to actually you want to participate in the secular growth of the teams itself, but you do not want to take secular idiosyncratic risks of companies, because remember, for disruptors, these are new business models. Some companies may get caught in new regulations. There could be a trade war somewhere, and they might get sanctioned and so on and so forth. So by doing so, we actually have got 100 companies with very small weights each, invested over different countries, diversified over different countries, and diversified over different teams. So by doing so, you actually get a lower risk kind of portfolio with minimized idiosyncratic risk, so that you can actually participate in this secular trend growth. So that's actually quite different from another approach which is on the other side, which is high conviction, right? You pick 30 to 35 stocks, let's say, I don't know, you could have a 10% stake in, let's say, Tesla. But the question is this: you must trust in the ability of the fund manager to navigate such that, in the case of, let's say, something happens, maybe tit for tat, the Americans actually had some sanctions of the Chinese companies. The Chinese companies now pick on, let's say, Tesla with a factory in China. Share price can come down, right? So the question is, do you trust in the ability of a fund manager to navigate this? If you do, then that will be the product for you. So different products with different strategy actually would appeal to a different group of people depending on the risk profile of the investor themselves.
I think we have touched quite a bit about growth, quite a bit about disruptive innovation. I want to divert our attention back to value. Hui Shi, where do you think you could find value in 2021?
I think for REITs, you can definitely find value in the REITs with strong growth potential. And those REITs with strong growth potential will be those industrial REITs, your data center REITs, and your logistic REITs. Because all these REITs, they hold assets that play a very important role in the digital economy, which is the economy of our post-COVID future. So for example, for the logistic properties, they actually benefit from structural tailwinds, such as the acceleration of e-commerce. And all these trends, they will lead to higher demand for such assets. And definitely, there's value in the REITs right now. If you look at the current valuations right now, since there has been a sector rotation from the REITs that have done well in 2020 and into out of the REITs who have done out in 2020. So their valuations have come down for quite a bit. And I think right now it's definitely a good buying opportunity for such logistic REITs, industrial REITs, and they are the way to go forward for every REIT investor's portfolio.
If tourism were to rebound, would retail REITs be attractive?
I think, yes, tourism definitely they will recover, but I think for the downtown retail malls, what you need to think about is from the time now until when the tourism recovers, it's going to take a few years, maybe 1 year, 3 years, or even 5 years. And right now, as we speak, the tenants in the downtown retail malls, they have been struggling because of COVID-19, and they are not totally out of the woods yet until tourism recovers. So actually, the occupancy rates of downtown malls, they will continue to fall because there will be more and more tenants who are going to pre-terminate their leases, and for some, they will not renew their leases. And as occupancy rates fall in this weak leasing environment, rental rates are also going to fall. And so for the downtown retail malls, it's actually going to be the survival of the fittest. Whereas if you look at the suburban malls, they are resilient and they have been slowly recovering back to their pre-COVID levels. In fact, I believe they were going to be recovered fully by the end of this year. So actually there's much lesser downside risk to the income for the suburban retail REITs. And therefore I think this is what investors should be focused on, which is on the suburban retail REITs, more so than the downtown retail REITs.
Yeah, I think we have spoken quite a bit about equities. Maybe I'll shift our attention back to bonds. Okay, firstly, there are not a lot of questions on bonds, but perhaps my question is, where do you think you could find high returns for bonds at this juncture right now, Dexter?
Yeah, so I think the panel has actually spoken quite a fair bit on stocks and funds. So I think we should all have a balanced diet. So it's always good to allocate some of the portfolio to bonds. I mean, ultimately, we all want to sleep better at night, right? So, so anyway, back to your question about which is the best performing.
Like,
What?
where do you think the best opportunities are right now for bonds?
Okay, so yeah, I think so. With reference to my earlier presentation, so this year we're expecting, we're a bit more optimistic. So we think travel will pick up. So within the travel sector, we think that this year we'll see a turnaround because of vaccination rates will pick up with the infection rates, and at some point in time we'll see a turnaround in the infection rates, and this will be positive for travel-related credits. So when it comes to credit, it's a bit. I think credit will improve first, then we can talk about valuations. But I think for credit, I think within the travel sector, the names, the bonds within the credit space are attractive, like airlines like Cathay Pacific Airlines, the 3.375% 2023 bond, and then Ascott Residences Trust, which was also mentioned by Hui Shi during a presentation. So the perpetual note, the 3.07% perpetual note. So these are some of the credits which we are also positive on. So if you're more aggressive, of course, you can look at other kind of bonds which are probably trading at a lower price, and of course a potential higher upside return. Yep.
Right.
So yep.
Yeah, thank you, Dexter, for like telling us. I mean, because I'm someone who actually know nothing about bonds. So I think it's quite interesting that there are bonds that can give you like really nice returns, 15-20% sometimes.
Yeah.
But I think we're running short of time. So I do want to kind of wrap this up by going back to the main theme of, I guess, just the questions that we have, which is what do you see as an appropriate allocation to technology as part of your overall equity portfolio? And I think maybe this is something that perhaps a question that's open to the floor.
I think I can start first.
Yeah.
I think when I answer this question, I actually speak on behalf of the research team at iFAST, because this is a methodology that we adopt at the company level, and also in terms of how we advise our clients. This is also something that we tell our clients. So in terms of how much exposure you must have inside your portfolio, I think one way to look at it is to look at the size of the digital economy relative to the global economy. And if you do a bit of calculation, a bit of numbers, then you realize that the percentage is actually about 10%. So this magical number 10% is actually something that we recommend to investors. So if you want to consider having technology and digital economy as part of your core allocation, as part of your long-run asset allocation, then we think perhaps 10% is something that you can start off with.
Perhaps any more, okay, I mean, for example, how if people were to invest in disruptive innovation, how much do you think it should form part of your portfolio?
I think the answer actually varies from person to person. Over here, I would imagine that it really depends on the risk bucket of the person himself. So if you are very near retirement, obviously you do not want volatility in your investment returns, right? And vis-a-vis when you are still starting off in your career, then you can actually take more risk. So the answer is probably it's a range, right? And actually it really depends on which part, how much risk you can actually take.
I actually do have a friend that came to me recently, and she was asking for my opinion on how she should structure her own portfolio. She has basically about 2 million in portfolio size, right? And she was asking me whether should she go for growth or income, right? Basically, I told her that it depends on your own objective, that what you mentioned. And she was actually looking for passive income around 60,000 a year. So I say, if you at the current market, I think you can easily look for stocks that gives you a 5% yield. I'm not sure about bonds, but she's very into equity, so I kind of talk to her in equity terms. And she kind of segregate around 1.5 million for income, and that will able to give her kind of passive income that she wants down the road, 20, 30 years down the road. And at the same time, she doesn't want to miss out the growth opportunity that's so exciting, right? That's happening. So I kind of told her that you can segregate the rest of the 30% for growth, right? But you wouldn't want to go for those crazy stocks. They are trading at crazy valuation, right? You want to go for those stocks that are on the secular trends at a reasonable valuation, right? So those are, again, it really depends on the personal objective. I mean, none of us can give you the exact answer. 10% I think is also a good metric. I personally restrict my exposure to certain sectors within 10%. Within the technologies itself, there are many subsectors, right? If you look at Alphabet, they are in the advertising space. You look at Amazon, they're in e-commerce and cloud. Okay, so they're kind of like segregated, diversified in that way. Yeah, so you invest in some of those big tech stocks, you are pretty much diversified. Just make sure you don't all in on Tesla, which I've seen a lot of people who really betting their money on 80% on Tesla, which sounds crazy to me when it comes to managing, I think, a portfolio. Yeah.
Yeah, well, I think that wraps things up. Firstly, I want to thank everyone for participating with our panelists. We hope this has been a fruitful discussion for all of you. Thank you once again, and good night.
Thank you, ladies and gentlemen, for the insightful discussion, and to our audience for your questions. We'll now proceed to the daily quiz, where 3 winners with the most accurate and fastest answers will walk away with $100 worth of FSM1 multi-currency cash account credits. To access the quiz, you'll need to be on Event Live. Click on Event Activities on the black menu below the video window. Under the agenda, look for the quiz schedule. Click on Join Quiz, and the activity window will be displayed on your right. Once the quiz ends, a leaderboard will be displayed, and you may check if you're one of our winners. If at the end of the quiz, the results screen show rank 1, 2, or 3, congrats! It means you're the winner. So to claim your prize, you have to take a screenshot showing the whole activity window and ensure that your rank, score, and nickname are captured clearly. Are you ready? Let's start the quiz. So we'll start with a warm-up question. What are the dates of What and Where to Invest 2021? Is it the 3rd to 10th of January 2021, 9th to 26th of January, or 14th to 28th of January 2021? Good job, 87% of us got it right. Now that we are ready, we'll move on to our first question very shortly. So be ready. Let's start. From a unit trust perspective, which of the following is not a mega trend that FSM1.com mentioned is currently shaping the world? Option 1, space exploration. Option 2, green revolution. Option 3, demographics. And option 4, digitalization. The answer is space exploration. If you didn't get this right, it's okay. We have 4 more questions to go, 4 more chances to climb up the ranks. Are you one of our top 3? If you're not, it's okay. Try better the next question. Remember, you have to be one of the most accurate and fastest answers to stand a chance to win. Question number 2. Which segments within S-REITs show signs of resilient growth? Is it office, hospitality, retail, or industrial and data centers? If you're one of our top 3, you will win $100 worth of FSM1 multi-currency cash account credits. And the answer is industrial and data centers. If you didn't get this right, brush yourself off and get ready for question number 3. Question number 3. Within the bond space, which of the following is not one of the 3 sectors that FSM1.com is positive on? Is it airlines, hospitality, China real estate, or consumer staples? Fastest fingers first. So pick wisely but quickly. The answer is consumer staples. Did you get this right? If you didn't, we have 2 more questions to go. Remember, our top 3 at the end of this quiz will stand a chance to win. Question number 4. Which of the following is not one of the 3 segments the recommended ETFs by FSM1.com focuses on? Option 1, e-travel. Option 2, digital health. Option 3, cybersecurity. Or option 4, mobile payments. And the answer is cybersecurity. We will soon move on to our final question. Check your ranks if you're one of our top 3. The next question will be a make or break. So be very ready for question number 5. If you get it right, you have a very high chance of being one of our winners. Final question. Which of the following is not a disruptor Lion Global Investors has highlighted when scouring for opportunities within disruptive innovation? Is it Gojek? Is it BYD Co Limited? Is it Nari Technology? Or is it Shenzhen Innovance Technology? The answer is Gojek. If you're one of our winners, you will stand a chance to win $100 worth of FSM1 multi-currency cash account credits. If your results screen shows rank 1, 2, or 3, you must take a screenshot showing the whole activity window and ensure that your rank, score, and nickname are captured clearly. Then you have to email the screenshot and also include your name, FSM account number, and daily quiz date to events@fundsupermart.com by 31st of January to claim your prize. That is all we have for you today, but what and where to invest is not over. Join us again next week on the 19th of January, where we'll have more insightful presentations from the likes of Chin Hui Leong from The Smart Investor, Stanley Ong from iFast Global Markets, and stock investment educator, Dr. T. In addition, Timothy Ho from Dollars and Cents, Don, the Budget Babe, and Kenneth Lowe from Sidley will be sharing on the 21st of January in a session dedicated to helping those who are new to investing get up to speed. Look out also for a special Chinese-only session on the 26th of January starting at 7 p.m. Don't forget to tune in, as each day we'll be giving away $100 worth of FSM1 multi-currency cash account credits to 3 lucky winners in the daily quiz. Each day is also a new opportunity for you to accumulate chances for the lucky draw happening on the 21st of January, where the lucky winner may stand a chance to win up to $1,000 worth of FSM1 Auto Sweep account credits. There will also be 10 consolation prizes of $100 FSM1 multi-currency cash account credits each up for grabs. It's goodbye for now, and don't forget to check out the rest of the promotions FSM1.com has launched in this period. We hope to see you on the 19th of January at 7 p.m. Thank you and goodbye.